Welcome to Acera's new employee / mid-career webinar. In this webinar, what we're assuming is that you are either new or you're somewhere in the middle of your career. That is why we called it the new employee / mid-career webinar. The bottom line there is that you are not yet near retirement, which is a good thing because retirement is a ways away, and that means you still have plenty of time to plan for your retirement. So in this webinar, I'm going to tell you all the things that you might want to know about doing that planning. Since you're curious enough about retirement planning itself, about your retirement planning to watch this, you probably have some questions. I found that people have a lot of questions. Probably the most basic questions that you have are, what do I need to know about my pension? Do I need to do anything? And if I need to do anything, what do I need to do? Tell me what I need to do. So I will do that. I have arranged the answers to all your questions, all your probable questions, into the form of this checklist that we're going to go throughout the seminar. First, I will help you understand some basics about the retirement system and your membership in the retirement system. Second, I will talk a little bit about pension math. It's very simple. It's not complicated. It's just a simple multiplication. And you don't need to do any math. I'm just going to show you how we do the calculation, and that will help you plan for your future retirement. So I'll talk about our retirement formula, and I'll talk about purchasing service credit. Next, I will help you get a pension estimate. And that is a little window into your future with Acera for when you go throughout your career and then you finally retire. Next, I will help you understand when you actually become eligible to retire, because it's not instantaneous, but it does happen actually pretty quickly, which I think you'll be surprised about. Next, I will help you understand some additional benefits that we have, like healthcare benefits, for example, and death benefits. We'll talk about designating your beneficiary or beneficiaries for those death benefits. I will help you understand career planning options. And by that, I mean that at some point in the future, you're going to stop working this job that you're working in, and you're going to go do something else. What are your options in regards to your Acera account and your Acera membership? Then I will help you make a retirement planning picture. Well, what do I mean by that? I mean that in retirement, you're going to need income to live. And so how do you get pointed in a good direction so that you have enough income to live in retirement? And it's actually fairly simple, and I think you'll be surprised about that as well. As part of that discussion, we'll talk about starting a 457B account. There is a question up in the Q&A. If you feel confident that you know everything that you need to know right now about the 457B account, feel free to, leave the meeting at that point. And if you did want to ask me more questions at that point, you could even feel free to rejoin the webinar at noon to ask additional questions. So that's up to you. There is a lot of good information about the 457B plan from the expert on it, so I do recommend hanging around for that unless you feel like you're well versed in the 457B plan, which is not part of Acera. It's a separate thing, and that's why we have an expert from the county come in and talk about it. Okay, let's jump right in. First topic, understanding retirement basics. Let's start at the beginning of the story. Who is Acera? In one sense, Acera, this acronym, is the Alameda County Employees Retirement Association. But it is made up of a lot of people. There are maybe 90 or so of us that work at Acera. And what we do at Acera, our entire job is to provide retirement and disability and death benefits to all of our members. So that is all of you. You are members of Acera. So you're part of Acera as well. And you are a member because of the position that you work in and who you work for. Currently, you either work full-time or at some point in the past, you worked full-time in a retirement eligible position. And for one of our 6 participating employers, these are the 6 county agencies that use Acera to provide retirement benefits to their employees. Okay. So if you work for one of these employers and you're in that retirement eligible position, you automatically become an Acera member. And actually, you don't have any choice. But it's actually a good thing because the benefits are powerful. So as an Acera member, with every paycheck, you contribute to the fund. through what is called your employee contribution. So this isn't free money we're giving away. In fact, this is your money. We're taking your money along with a contribution made by your employer every time you make a contribution, and we're going to invest it all over the world. And it is your contribution, these deferred wages that you give to us to invest, and your employer's contribution that we invest, and the investment earnings that give us this big pool of money we call a Sarah's fund. You can verify that by looking at your pay stub. In the before tax deductions column, you will see a line that says something like retirement, and then there's a tier number there. We'll talk about your tiers in just a few minutes. And you'll see some money coming out of your check and going into a Sarah's fund for us to invest and save for you for the future. Okay, so now that we know about a Sarah's fund and we have this big pot of money, what are we doing with that money? We're not just collecting it for no reason. What is going to happen with it? Well, you are, as an Acera member, earning credit toward retirement as you work. So throughout your entire career, you're earning more and more credit toward retirement. And then at some point in the future, you will retire. And what that means is you stop earning credit toward retirement and you start collecting the retirement that you've earned throughout your career. And this comes in the form of a check that you receive every month for the rest of your life. Every month for the rest of your life. So you cannot outlive your retirement. It is a steady, monthly, regular source of income that is guaranteed that you can count on for the rest of your life. And that stability, that security is very powerful to help you actually plan for retirement, because you know you're going to get that payment every month for the rest of your life. And you can predict what that payment is going to be by getting pension benefit estimates, which I will show you how to do. Okay. Now you'll see here that it says retirement allowance, but I just said pension benefit. We have a lot of synonymous terms for this concept, so you might hear me throw out a lot of them. Retirement allowance, retirement benefit, monthly allowance, monthly retirement allowance, pension benefit, monthly pension benefit. These are all synonyms for the same thing, which is this monthly payment that you receive every month for the rest of your life. Pensions are special. As somebody who participates in a pension, what's going to happen is that you're going to pay into the pension system with every paycheck your entire career. Okay. Then when you go to retire, we are going to give you all that money back in the first 3 to 5 years through those monthly pension payments. Well, what happens after that? Has the money run out? No, because like I was saying before, it's a lifetime pension. The money never runs out. So that means that for every year you live after the first 3 to 5 years, let's say you live another 15, 20, 25, 30, 35 years after you retire, it's like this amazing bonus that you get to take advantage of, this secure pension payment that you get to take advantage of for the rest of your life. And you've already gotten back all of the money that you paid in. And the reason that we're able to do that is through, in addition to the employee contributions, the employer contributions help there, but it's actually the interest that pays for 3/4, for 75% of your lifetime pension. So that's why we're investing your money, is because then we can gain power, the power of being able to provide you a secure benefit for the rest of your life. Okay, so let's see. I see a question up here. If you're about 1 to 2 years before retirement, does this mean that the seminar is not really for you? And do you have a seminar that is for the people who are closer to retirement? Well, yes. The short answer is yes. We have a seminar that is for people closer to retirement, and it's called the pre-retirement webinar. We're actually doing that one live tomorrow. It starts at 9 a.m. There's still room, so you can sign up for that out on our website at acera.org/seminars. But a lot of the information is going to be overlapping. Like everything I tell you about the retirement formula is going to be overlapping. There is a whole probably 20 to 30 minute discussion on vacation compensation that we don't do in this webinar. So we do in the pre-retirement, we talk extensively about healthcare. We talk about the 5 retirement options that we don't do in this webinar, but a lot of it will be the same. So you can hang out and watch this one if you like, or you could go sign up for the one tomorrow and and feel free to do that. If you don't have time tomorrow, we do have many different recordings of the pre-retirement webinar sitting out on the website right now at acera.org/seminars. You are welcome. Okay, what you're looking at is a pension milestone chart. These are some of the milestones, probably most of the milestones that you will see regarding your membership with Acera as you go through your career. Okay, and it's good to have these in mind. This kind of gives you a framework to track your progression through your Acera membership. First, you have your date of hire, which is the first day that they told you to show up to work in your full-time retirement eligible position. If you started out in that position, this would actually be physically the first day that you are at work. Now, some of you may have started out part-time working for your employer. This would be the first day that you graduated up into that full-time retirement eligible position. Okay, then for most people, the vast majority of people, 2 weeks goes by, and the first day of your second pay period is your first day of membership in Acera. And this is the day that you start earning credit toward retirement. Now, two of our employers, the Housing Authority and Livermore Area Recreation and Parks District, there is no 2-week lag time. So these 2 days are the same. Your first day of work is your date of entry into Acera. But for everyone else, 2 weeks later, that's the day when you start earning credit toward retirement and you become an Acera member automatically. So you don't have to do anything to become an Acera member. Okay, then what happens is 5 years goes by, or the equivalent of working 5 full-time years. And once you have earned 5 years of service credit, which I'll explain what service credit is in a few moments, once you have basically worked 5 full-time or the equivalent of 5 full-time years, you are considered vested in the retirement system. And when you're vested in the retirement system, you then gain access to a whole set of benefits after that 5 years that are guaranteed benefits. Vesting kind of just means guaranteed. So when you're vested, you gain access to the guaranteed benefits, the vested benefits. Then some other period of time goes by, and this will depend on your situation, but there's some combination of your years of service credit and your age that get you to retirement eligibility. So it's a little bit different for everyone. It depends on when you started. But I will show you what those different combinations are that get you to retirement eligibility a little bit later. But this is the first day that you could actually retire if you wanted to. Now, many people don't do that. Many people will continue working after that to earn more and more credit toward retirement. Probably most people do. And then what happens is sometime after you become eligible to retire, you can actually stop working and retire. Now, this milestone right here is your last day of work. This is also known as your termination date or your last day on payroll. This is the day that you stop earning credit toward retirement. And for the vast majority of people, what happens is you stop working one day, and then the day after that is your first day of retirement, and you go straight into retirement. Now, some people won't do that, and that's perfectly fine. You will become what we call a deferred member. You will stop working and you won't retire yet, and you will maintain your Acera membership, and you say, I'm going to defer my retirement to a later date. And then there would be a gap in between these two dates, and that's perfectly fine. We'll talk about that a little bit later. But your retirement date is the day that you start collecting the retirement that you have earned, and you will collect it for the rest of your life every month, like I said, until your death. At the time of retirement, you will have the opportunity to choose among our 5 retirement options, which we talk about in the pre-retirement webinar. But they come with different death benefits. Many of them come with the ability to provide a continuing payment known as a continuance that your beneficiary would get every month for the rest of their life. And so that is why there's another milestone on there for your beneficiary's death. So that would conclude us paying benefits, the benefits that you have earned with Acera. Okay, and then there's a question, so you don't have to be vested at the same employer. If you're referring to reciprocity, which I will go into in the second half of the presentation, where you are you do some work for another California public agency, you come to Acera and do some work and you link them together, all of the service credit combined from all of the linked systems will get you over that 5-year mark and will get you over the retirement eligibility mark. So that's one of the powers of reciprocity if you are changing jobs and changing agencies. And I'll talk all about that later. So you can expect me to address all the reciprocity questions. And the 5 years of vesting does include any reciprocal service. The guarantee that I told you, because vesting means guaranteed, the guarantee is by state law. The state law tells us how to run the entire system. It tells us how to do all the calculations. We run by the state law, and that's where the guarantee comes from. And the vested benefits are, the guaranteed benefits are the lifetime monthly retirement allowance, an annual cost of living increase to that retirement allowance, and a $1,000 lump sum death benefit, which is sort of like a small burial benefit. There are other death benefits depending on which one of the 5 retirement options you select. And I'll probably mention that a little bit later as well. Let me tell you about your tier. You all are in one of Acera's tiers. And here's how you find your tier, and here's how the tiers work. They are based on your date of entry into Acera. So remember, this is your first day of Acera membership that we're talking about. Now, to find which timeline to look at, first of all, safety members. Safety members are sheriff's deputies and probation officers, and there may be a few other sworn officers in there. So you are going to look at the bottom timeline. Now, everyone who's not a safety member is a general member. So most people are general members. And if you're a general member, you are going to look at the top timeline, unless you are a general member for the Housing Authority or a general member for Livermore Area Recreation and Parks District. And then you're going to look at the timeline for your employer. So the way this works is if you entered Acera before the cutoff date for each one of the tiers, that puts you in the earlier tier. So let's say you were a general member, you entered Acera before July 1st, 1983, that would put you in tier 1. If you entered Acera July 1st, 1983, all the way up to December 31st, 2012, that would put you in tier 2. If you entered Acera January 1st, 2013 and beyond, that would put you in tier 4. And that tier 4 date is the same for all of the timelines. You can see the safety members have a few more tier 2 versions of tier 2. If you're in tier 2C or tier 2D, that was a choice that you made when you gained your safety membership. Now, if you don't remember which choice you made, or actually for anyone, if you don't quite remember your date of entry, so you're not too sure which tier you're in, the best way to figure that out is to log into your account on our website. You just go to acera.org, you press the login button, log into your account, and it will say not only your date of entry, but it will tell you your tier definitively. Okay. So that's how your tier is determined, by when you enter Acera. And, also if you work for one of the Housing Authority or LARPD, there's a few different cutoffs. So that's how that works. Okay, now I'm going to show you this slide now, just to give you some context for our entire discussion that we're having. And then we'll return to this idea toward the end of the presentation. Okay, so financial planners will say, this is their kind of target that they like to point people toward. They will say that in order to maintain your standard of living in retirement, you are going to need 80% of what you were making before retirement while working your job. You're going to need 80% of your salary in retirement as retirement income in order to maintain your standard of living. And that 80% will come through a combination of income from different places. One of them is going to be your Acera monthly pension. One of them will be Social Security, if you are paying into Social Security, which everyone is except for the safety members. But even the safety members, if you have previous work where you worked for at least 10 years somewhere else, then you can collect Social Security. And then everything beyond that is savings and investments, your own personal savings and investments. Okay. Now, this might be, it used to be for me a little nerve-wracking thought. Like, how am I going to replace 80% of my salary when I stop working? Well, it's actually not that complicated. And I'll show you how to do it. I'll show you how to get estimates of a SARA and Social Security and then get pointed at any additional savings you might need to do to fill in the gap to get pointed in the 80% direction. So like I said, it's not too complicated. For right now, what we're going to do to kind of give you a map of what we're going to talk about is that we'll talk a lot about the ACERA monthly pension. Then we'll delve into getting a Social Security estimate and figuring out how much additional you might want to start saving. Because you can narrow in on an actual amount that will get you pointed at 80%. Okay, so let's move on to the next topic, understanding, and there's a question, is that 80% net or gross? I think that's gross income. And gross income is before any deductions are taken out. Okay, so understanding pension math. So this is just a little bit of math. Okay, when you go to retire, we are going to do this calculation for you. When you go to retire, your retirement allowance is going to be a percentage of your highest salary for each year of service that you work. So this sentence is telling you in English what this equation is doing for you. Let me give you some numbers and it will help illustrate this. And the reason I'm telling you this right now, because you may be thinking, well, I'm new. I don't know. I don't need to know how you're going to calculate my retirement when I get there. I'll cross that bridge when I get to it. Well, you can do that. But if you understand how this works, and it's actually pretty simple, you can maximize what your monthly retirement allowance is going to be by the time you retire, just by knowing how to maximize each of these three numbers. So I'll tell you how to do that. First, let me explain how the equation works, okay? So let's say that the percentage of your highest salary that you are going to get for each year of service is 2%. To put another number in here, let's say that you worked full-time for 20 years exactly. So you earned 20 years of service credit. That means that you are going to get 2% of your highest salary for each individual one of those 20 years. So if you line them all up, 2% plus 2% plus 2% plus 2% 20 times, basically 2% times 20 is 40%. That means that your retirement allowance is going to be 40% of your salary. To give you another number, to keep going with the example, let's say that your salary is $5,000 per month. This is your highest salary, probably right before you retire. You're going to get 40% of that as your monthly retirement allowance. So we take the $5,000 salary, multiply it by the 40%, and your monthly retirement allowance for life is $2,000. Now, I just told you that 80% is the target that you're looking for to maintain your standard of living. But if you remember, there's two other sources of income there. And if you did get to 40% from your SARA pension alone, that would actually be really good. And you would be well on your way to getting pointed at that 80% between the pension, the Social Security, and the personal savings. Or in some cases, if you work long enough, just the pension and Social Security. Somebody's saying I cut off. It looks like the sound is still working. Can everyone else hear me? Go ahead and let me know. Okay. So maybe it's just your computer that cut off. Yeah, thanks for letting me know. Okay, excellent. Okay, so the bottom line here, the reason I'm telling you this whole thing now is because if I show this to you, that helps you maximize what this monthly retirement allowance is going to be. So because it's a multiplication, the higher that any of these three numbers are, the higher the age factor percentage, the higher the years of service that you earn, the higher the salary is that you earn, equals a higher monthly retirement allowance for life. That's how you maximize your retirement, is by maximizing these three numbers. So let me tell you about how to maximize each one of these three numbers individually. I'll start with the age factor percentage. This one's pretty easy. So the question is, what age factor percentage will you get for each year of service? Because it's not necessarily going to be exactly 2%. It's going to depend on your age at retirement. What you're seeing here is a sample age factor chart. So these are some of the age factors that represent what we're going to put in the formula for you when you retire. So the way to navigate this chart is, first of all, you find your tier. So if you're a general tier 4 member, you just look at this column. And once you find your column, you forget about all the other columns because they don't apply to you. Okay, so what's going to happen is when you go to retire, let's say you're a general tier 4 member and you are going to retire at age 60. We're going to have to do that retirement formula calculation. We're going to have to put a number in the age factor percentage spot. So we're going to come to this chart. We're going to go down to age 60. We're going to come over to tier 4, and we're going to see that 1.80% is the percentage of your salary that you're going to get for each year of service. This is what we plug into the formula for you. Now, you'll notice a few things about the chart. One is that the numbers get bigger the older you are. So that's how you maximize this number, is by retiring at an older and older age. The older you are when you retire, the higher the age factor percentage is going to be for you that we use in the formula, up to a cap. So there's a point where they stop getting bigger, and that's represented by the blue box on the chart. So you can see that if you're a general tier 2 member and you retire at age 62, you haven't reached the cap yet, 2.09%. But if you retire at age 65, that is the highest age factor percentage you can get for your tier, 2.43%. So if you retire at 66 or 67 or 77, you're still going to get that 2.43%. Another thing that you will probably notice about the chart is there's a bunch of gaps in the ages. I jump maybe like 3 years or so every time. But really, if this were the full chart, you would see slight incremental increases with every quarter year. And the reason I can't put that whole thing on the slide is because it doesn't fit, because there's so many incremental increases in between these. So if this were the full chart, it would say 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, 53 and a quarter, and so on and so forth. And there is a slight increase in the percentage every time you pass a quarter year based on your birthday. So for example, if your birthday is January 15th, you go by the number and you just add 3 months. So April 15th is the next quarter. You pass that day, you don't retire. You go up 1 notch in the chart. You get a slightly higher age factor percentage. July 15th, you pass that day and don't retire. You go up another notch in the age factor percentage chart. So it keeps increasing. The percentage keeps increasing with every quarter year until you finally retire. And I think that is all I need to tell you about the age factor percentages. Now, I just threw a ton of information at you about the age factor percentages, but some of you, especially if you're new, you might be thinking, I don't need to know all that detail. That's a lot of detail. So if you don't remember anything else about the age factor percentages, just remember the bottom line, which is an older retirement age equals a higher age factor percentage, a higher percentage of your salary that you're going to get for each year of service. And of course, up to the maximum for your tier. Okay, there is a question up on the board. Is there a cap on highest salary Sarah considers in the equation? Maybe. There is for tier 4, and I'll get to that a little bit later. So I'll revisit that question. Okay, so we talked about the age factor percentage and how to maximize that by simply retiring at an older age. Okay, how do you maximize service credit? Well, there's a couple of ways. Let me explain what service credit is first. Service credit is measured in years. You start earning service credit on the day that you enter ACERA, and you earn service credit all the way up until you stop working in your job. So you're earning service credit as you're working. You earn service credit during your regular work hours. You also earn service credit during your earned vacation leave And all of these other types of leave, sick leave, management leave, comp time, holidays, floating holidays, those don't count against you in terms of calculating your service credit. You're already earning service credit for it. Okay. Now, I said service credit is measured in years. It's actually measured down to the fraction of a day. Every 15 minutes you work, you earn 15 minutes of service credit, and you'll get all of the decimal places after the whole year. You'll get all of that in the formula for you. Okay. Now, there's some times when you don't earn service credit. You don't earn service credit if you're ever on leave without pay. If you're not receiving a paycheck from your employer, you're not earning service credit. Okay. If you purchase additional vacation, and this is something some of our employers allow, where you purchase extra vacation that's more than your earned vacation, you don't earn service credit when you go out on that purchase of vacation. When you mark that on your timesheet, you're not earning service credit during that time. But I will tell you that if you take a purchased vacation week here or there, I don't think, whenever I've done the math, that it has that big of an impact. When you're looking at your total career, I don't think it has that big of an impact on your retirement allowance. It might mean that your retirement allowance is a few dollars less. So I wouldn't sweat it if you've already purchased a bunch of vacation, or if you need to purchase vacation in the future because you need to take a vacation for your health. Next item is sold vacation. Now, some of our employers will allow that. You take your earned vacation, you sell it back to your employer for cash. You can do that and you'll get the cash, but you won't get any service credit. Okay. And that's totally fine. You can do that. You will be earning service credit during the week that you would have taken vacation because you're working and not taking vacation. Now, you also do not earn service credit while you're on overtime, on-call time, or standby time. Okay, so those don't count. Let me see. There's a bunch of questions that just popped up. Okay, so that's about retirement eligibility. So I'll save that question for later. Okay, for years of service credit, does sick time, paid time off, or non-paid time off count? In order to earn service credit, you actually have to work the time or use the time, the leave time, while you're still employed. So you need to work the time or use the earned vacation, use the sick leave, use the management leave, comp time, holidays, floating holidays, etc., while you're still employed. Now, a lot of these categories, everything except for earned vacation, is use it or lose it, except for sick leave. There is, for people who go straight into retirement, we will convert your sick leave on a 2-to-1 basis to service credit. And I'll talk about that in just a minute. We will do that. But otherwise, you're going to want to use your management leave, comp time, holidays, floating holidays before you stop working, because those are use it or lose it. Okay, that I think is about reciprocity. Okay, there's a question, when you meet the 5 years of service credit for vesting, how do you get notified? We don't really notify you, but what you should do, and this is a good practice, is to log into your Acera account every once in a while, just to make sure that the service credit number in there looks correct, and all the other things look correct. You can check your birth date, make sure we have that in our database correctly, stuff like that. But that's how you would know how much service credit that you have. And the info about selling vacation is where you take your earned vacation and you sell it back to your employer for cash. So let's say that you have 3 weeks of vacation on the books and you say, I need some extra cash. I'm going to sell this 1 week of that back to my employer. They'll give you a week of extra cash right now, and then your vacation balance goes from 3 down to 2. And then you have 2 weeks of vacation that you can use in the future. And you don't get service credit for selling vacation. Retired annuitants do not continue to earn service credit. A retired annuitant is somebody who retires from Acera and then comes back to work for their employer or one of our 6 participating employers. They're an Acera retiree. Their retirement has already been calculated. So once you retire, we calculate your retirement, and that's what your retirement allowance is going to be every month for the rest of your life, including cost of living increases. And so you don't earn a second retirement as a retired annuitant, and you don't earn any more credit toward retirement. Okay, so I told you there's two ways of maximizing your service credit number. The first way, of course, is working longer and earning more service credit, working a longer career, earning more service credit. The second way is if you have one of these types of eligible time, you can purchase additional service credit, and that will increase your service credit number in the formula for you, which means that your retirement allowance will be higher. The theme here is that these types of time that you're seeing on this list are times where if the situation was slightly different, you maybe could have earned service credit, but the situation being what it was, the law doesn't allow for, you to earn service credit, but it does allow for you to come back and buy that time later. Okay. So let me go through these. The first category is ineligible non-covered service purchase time. So for example, if you started working for your employer part-time, and I'm not talking about working for a temporary agency or under contract or an employment agency, this is just plain old part-time, you can go back after you achieve your full-time retirement eligible position and buy that part-time work because you were not earning service credit for that part-time work because you were not yet an ACERA member, because you have to achieve the full-time retirement eligible position to enter ACERA. Now, later you can go down to part-time if you make that agreement with your employer and you maintain your ACERA membership and you keep earning service credit, but at a slower rate. But the part-time work that you did before your membership, you can go back and purchase that. The same is true with TAP time. That stands for the county's temporary assignment pool, and all of that time is purchasable. Also, you may have done some work prior to your ACERA covered position that was labeled seasonal or intermittent or service as needed or project or per diem. All of those types of time are purchasable. Okay. Then we have the 2 weeks between your date of hire and your date of entry is purchasable. If you ever during your career go on unpaid medical leave, and often this is where you go out on medical leave, you burn up all your sick leave and probably your vacation leave, and you still have the medical condition, so you're still out on medical leave. You're still employed. You're just on unpaid medical leave. When you return from that medical leave, you can buy all of that unpaid medical leave time up to 1 year per instance. So if you go out on unpaid medical leave for a year, you return to work and receive at least one paycheck. Then you go back out on medical leave for another year. When you return from work, you can buy that second period. When you return and got the paycheck the first time, you could buy the first period, but you could buy both of those 1 year periods. So that's how that works. State disability insurance leave, very similar. If you're out on state disability insurance leave, when you return from it, you can buy that time. Now, if you're out on workers' comp, which is related, sometimes what will happen is you're paid partially from the workers' comp system and partially from your employer. Any paycheck you receive from your employer during that time, you are earning service credit during that time already. So you can buy back just the workers' comp portion that you did not earn service credit for, upon returning from the workers' comp leave. Military leave during membership. I do see a question about that. This is military leave that you go out on during your active membership, which means you have your job, you leave and take a military leave to go serve in the military. And then when you return from that, then you can purchase that military leave. You cannot purchase prior military service unless it was before, I think the cutoff was like 1973. So I don't think there are a lot of people around working anymore that have military service before 1973. So that's how that works. And then these two redeposits. Okay, let me explain those. The first redeposit is of prior membership is where you were formerly an ACERA member. You're working for one of our employers. You quit or left that work. And when you did that, you took a refund of your contribution account of all your employee contributions. And when you did that, you lost all your service credit. You canceled your ACERA membership. Now you're back working here again, and you want to get that service credit back. You can put that money back, and that's called a redeposit of a prior membership. and then you get your service credit back. Now, the redeposit of community property, this is where you are an ACERA member, you're married while you're earning retirement benefits toward ACERA credit toward retirement, or you're in a state-registered domestic partnership, and you get divorced or you dissolve that domestic partnership. Any portion of your ACERA account that you earned while you were in that marriage or domestic partnership is considered community property. And often what happens is you go through the agreement process, the divorce process, and then part of your account gets split and given to your ex-spouse. They take part of your service credit and a corresponding portion of your balance of your contribution account with them. Now, at that point, they have the option at any point in the future of getting a refund of their account. So if they take that money out of the bank, out of ACERA's bank, we will send you a letter in the mail that will let you know that they did that. You have the opportunity to redeposit an equivalent amount of money, and then you would get all that service credit back. And then as a redeposit of community property. And then the final category is called Other California Prior Public Service. This is where you used to work for another agency in California, and you are not eligible to collect a pension from whatever pension system they use, usually either because you didn't work there for long enough to qualify for benefits, or when you stopped working there, you took a refund of your account from their system. Now, upon taking the refund of your account from their system, you can purchase that time as a ACERA service credit. So, for example, if you used to work for East Bay Mud for a year, you left there, you took a refund of your account, you could buy that year and increase your years of ACERA service credit by 1 year. So you could buy all of that time as a ACERA service credit. Okay, and there's a question, is the unpaid medical leave unpaid if you received paid family leave from the state? Yes. The unpaid part refers to you not being paid by your employer. When you get paid by your employer, you earn service credit for time that you work or leave time that you're taking. So yes, anytime you're not being paid by your employer, you're not earning service credit. And then if that time falls into one of these categories, it becomes purchasable. Okay, so there are some times, because I told you what is eligible for purchase, there are some times that are not eligible for purchase. Vacation purchase time. I said that you can purchase additional vacation on top of your earned vacation. Whenever you go out on the vacation purchase time, you don't earn service credit for it, and you can't come back later and purchase it. But like I said earlier, don't sweat that, because a vacation purchase week here or there is not going to make a big impact across your entire career on your retirement allowance. Okay, non-medical leave without pay time is not purchasable. Oh, and let me just point out that the purchasable unpaid medical leave time is only for your medical condition. It's not if you're on medical leave helping a family member out. So it's only for your medical condition. Okay, now what else is not purchasable is any contract time that you worked or temporary agency time that's not purchasable, or if you're trying to purchase that other prior public service time and you have not yet taken a refund of your money from their pension system, you need to go ahead and do that before we will allow you to buy that time with ACERA. Okay, so there is a question up there, how do I make the purchase? Before I get there, let me tell you about what it's going to cost you to make a service credit purchase. Should you want to do it now, or should you incur one of these types of time in the future and you want to come back and make that service credit purchase later? So what it's going to cost you is whatever your employee contributions would have been had you worked that time. For example, let's say that you go out on 3 months of unpaid medical leave, and then you return from that unpaid medical leave and you want to buy that 3 months. Well, had you been working here for that 3 months, you would have had to contribute a certain amount with every paycheck to ACERA's fund, and you would have seen that come out of your paycheck. Whatever that amount would have been at that time, based on your contribution rate at that time and your salary at that time, that is what it will cost you to purchase that time, plus interest. Because if you had been here to work that time and you had contributed your contributions for that 3 months in this example, we would have taken that money and invested it, and over time it would have earned interest. And so the longer you wait to purchase service credit, the more expensive it gets because of the interest that that money would have made over longer and longer periods of time. And we measure this by our interest periods. We have 2 per year. One ends on June 30th, one ends on December 31st. So every time you pass one of those dates, that's when we post interest. And so you would owe more and more interest on top of the contribution portion that you have to pay to make the service credit purchase. So let's say that 3 months of unpaid medical leave was 5 years ago that you're trying to buy. Well, that's 10 individual 6-month interest periods where that money that you would have paid in would have made interest. And so you have to pay all the interest that it would have made. We do all the calculations for you. Okay. So the way that you make a service credit purchase or even inquire about how much a service credit purchase will cost is by logging into your account on our website. You can go to acera.org/login or just go to acera.org, press the login button. And what we will do is once you submit that purchase redeposit request in your account, we will do calculations and send you a letter. And it will tell you whether the time is purchasable and how much it's going to cost. And at that point, you decide if you want to make the service credit purchase and if you do, how much you want to purchase. Because going back to the list of eligible service credit purchase times, if you decide that you only want to buy part of the service credit because maybe you feel like it's a little expensive, but you can afford part of it, you could do that with everything except for the redeposits. The redeposits are all or none, but the other ones you could just buy a piece of the time. And regarding cost, one more thing I'll say is that for all of the types of time that count toward vesting, because these will increase your service credit for the purposes of vesting and retirement eligibility, for these, you are only paying the employee contribution portion. Remember the slide I showed you? It was like the third slide in where I showed you you're paying an employee contribution, your employer is paying an employer contribution. When you make a service credit purchase in these categories, these top categories, you're only paying the employee portion. For the bottom category, you're paying both because the employer was somebody else, and your employer is not going to want to put those employer contribution funds in for this type of purchase. So this one's more expensive. The other California Prior Public Service, it can cost double or triple of what the other ones cost. Okay, and then if you do decide you want to purchase the service credit, you have all of these options. You can write us a check, pay on a post-tax basis. You can roll over funds from a pre-tax retirement account. Those are listed out here. You can do payroll deductions, which will split up the cost for you over time and will take it directly out of your paycheck, your working paycheck, and to make it super easy for you. And you don't really have to think about it, or we will do any combination that you like. Okay, so let me check the question board here. Okay, is there a deadline for buying service credit? The only deadline for buying service credit is that any service credit you want to have included in your retirement calculation when you retire has to be purchased by the time you retire. So that's the only deadline. You got to purchase it before you retire. Now, like I said, there's kind of like a little bit of a deadline built in. It's not really a deadline, but it's like an incentive to buy it as early as possible. The time to buy service credit is as early as possible because it's way cheaper, unless you want to pay a lot of interest. So you may not have one of the types of eligible time now, but going forward, if you do incur one of those times, remember that the earlier you purchase service credit, the cheaper it is. And then there's a question, you would actually have to submit a request in order to see how much and how frequently the payments would be. Okay, so there is a way, I should just write this up on the website and show people how to do it. There is a way where you can kind of do it yourself. You can kind of get a ballpark estimate of what it's going to cost. And the way to do that is by you can go back and look at your pay stubs and you can see what your contributions were for each pay stub around the time that you're trying to buy. And then you can take those and add them all up. to take the, like if you're trying to buy 3 months of unpaid medical leave, look at the pay stub right after you return and see how much you were contributing with each paycheck to the system, the retirement system. And then you take that and you multiply it by the number of pay periods in that time that you're trying to buy. And then that will give you a ballpark. Now, that will give you a ballpark of the contribution cost. If it's been some time, that time was a while ago, and you want to see how much interest you're going to have to pay, there is a way. If you enjoy doing a little bit of math, you can go out to our website. You can type in acera.org/contributions. And on our contributions page, we do list our historical rates of interest. So if you scroll down past the contribution rates and you go to your contribution account, there's this accordion here. How much interest does Acera post to my contribution account? And you can see what each one of the interest rates was for each one of the periods going back in time, the 6-month periods. And so you would just have to get out an Excel spreadsheet and figure out how much interest you would have to pay, because you just take all the interest periods between the time that you're trying to buy and now and multiply those into it. So I'll probably add a way to get a estimate of that. I'll probably make it easier in the future, but I don't have that on the website right now. But that's how you would get your own estimate. Otherwise, if you don't want to do that, just submit the purchase request form and we'll do it for you. Okay, I see a question up here. I worked with the county for 2 years, 2017 to 2019, in a project-based position. But I was told I could not earn credit toward retirement since I was not a permanent employee. But now that I have a permanent position, can I buy back this time to reach the 5 years? Okay, so let's go back to the list of service credit purchases and see what we find. So you said it was a project position, and so that's on the list. So it is likely, I'm like, 99% sure that you can buy that time, that 2 years, and that would be a good idea because that wasn't that long ago and you won't have to pay that much interest on it. So yeah, project time is purchasable, and that counts toward vesting. So again, that will get you over that 5-year mark toward vesting, and get you and that will count also toward your retirement eligibility, which I'll talk about later. Okay, so lots of people ask this question. I would say about half the time somebody asks this question. So I just decided to go ahead and make some slides to show you whether purchasing service credit is worth it. So here's how you do it. It's a very simple step-by-step process. Step 1, if you're wondering whether purchasing service credit is worth it. So you have some time that you're thinking about buying and you're thinking, should I do this? Well, you can figure it out for yourself. Step 1 is that you go ahead and submit the purchase request to Acera and you wait for the letter in the mail. Can take a little bit of time because we get a lot of these requests. It could take some months to get this back. Okay. So you get the letter in the mail from Acera. It tells you how much it's going to cost. Okay, so now you know how much it's going to cost. Now you go out to our website, you log into your account, acera.org/login or acera.org, and then press the login button. In there, you are going to use our benefit estimator tool, and you're going to make 2 estimates, okay? This is what the benefit estimator tool looks like. You're going to make 2 estimates, and you're going to think of a plausible retirement scenario for you. Like, you're probably going to retire maybe around 15 years from now or 20 years from now or whatever it is for you. And then you just pick a couple of dates that match that scenario. Now, there's separation date in here, which is your last day on payroll. There's projected retirement date, which is your first day of retirement. These have to be at least consecutive days. These have to be at least 1 day apart. But for some people, maybe you know that you're going to stop working at a certain point and not retire yet. So there might be some distance between these dates. But if you kind of think you might work straight into retirement in this position, or you just want to see what would happen if you do, you just pick 2 consecutive dates that fit your plausible retirement scenario. You hit calculate, and it will give you a projection of how much service credit you will have earned, and it will give you a salary projection. You hit get estimate. And first of all, you leave this field blank, the override service credit field, you do not put anything in there for estimate number 1. You hit get estimate. You will end up with a PDF estimate with a dollar amount on it. This is a projection of your future monthly pension benefit, your future monthly retirement allowance from Acera. That's estimate number 1. Estimate number 2, you do exactly the same thing. You use exactly the same 2 dates in the benefit estimator for your retirement date. It's the exact same scenario with one difference. You're increasing your amount of service credit by using the override service credit field. So you take the amount of service credit that you're thinking about buying. Let's stick with that 3-month unpaid medical leave example. 3 months is a quarter year. You got to convert it to years. So 0.25, you would take the 0.25 and add it to the projection it's already giving you and put that new total in the override service credit field and hit get estimate. Estimate number 2 is going to have more dollars than estimate number 1. It's going to be a higher estimate of your future monthly pension benefit because there's more service credit in there that it's calculating. All you need to do is look at the difference between the 2 estimates, subtract the smaller one from the bigger one. And that tells you how much more retirement allowance you are estimated to receive because you're making that service credit purchase, okay? Then you take the purchase costs that we told you how much it's going to cost to make the service credit purchase on the letter, and you simply divide that total dollars by the monthly difference, by the increase from estimate 1 to estimate 2. So for example, let's say we send you the letter and we tell you it's going to be $1,200 to purchase the service credit. And when you ran the estimates, you found that there was a $100 difference. Purchasing that service credit increased your retirement allowance by $100, but from estimate 1 to estimate 2. Well, you take the $1,200 divided by 100, and it will take you 12 months to get that money back when you retire. So when you retire, if you do make the service credit purchase, your retirement allowance will be more like estimate 2. It'll be higher. You will have paid for it, but it will be higher. And so because you're getting those higher retirement allowance payments, because you bought more service credit, you will eventually get all that money back that you used to make the service credit purchase. Now it's up to you to decide how long it takes to get the money back, whether it's worth it. If it takes 12 months to get it back, I think that's well worth it, because your first 12 months of retirement, you are, getting getting the purchase cost back, and then everything after that, you are having a higher retirement allowance for the rest of your life because you made the service credit purchase. And so that's a really good deal. Now, let's say that you do the math and it's going to take 5 years to get the money back, 5 years of increased retirement payments, or 10 years, or 15 years, or 20 years. Well, then when it's stretching out on that long of a timeline, then you kind of have to weigh, whether it's worth it to do it now. So that's how you figure that out yourself. So let me check the questions here. Okay, so you're asking 401k programs allow you to withdraw money before retirement to use for purchasing a house. Does this program offer like that to help purchase a house? No, it does not. You have no access to the money in your Acera contribution account. So you cannot use it. You cannot take a loan from it to buy a house or anything like that. Now, if you have a 457B account, you can do that. And Gene Hilliard, the representative from the deferred compensation program that's going to come on at 11:15, can tell you about doing that. Okay, and let's see here. So there's 3 questions up on the board that are about future topics, so I'm going to save those. Okay, so I told you how to maximize the age factor percentage by retiring at an older age. I told you how to maximize the service credit number by working longer and earning more service credit, and perhaps purchasing service credit if you have eligible time. The third way to maximize your retirement allowance is through your salary by earning higher and higher salaries. Okay, so that's the third multiplier in the formula. So when you go to retire, how do we do this calculation? Okay, well, the law tells us that what we need to do is find your period of highest pay from your entire career. And this in pension lingo is known as your final compensation period. This is your period of highest consecutive pay from anywhere in your career. For the vast majority of people, this is the period at the end of your career. But for some people, um, it might be a period earlier in your career because some people will take a different position, toward the end of their career that maybe has less stress and they'll earn a little less money. So then your final compensation would be earlier in your career. If you're in tier 1 or tier 3, your final compensation period, your period of highest pay from your career, is your highest 26 biweekly or 12 monthly pay periods from anywhere in your career. If you're in tiers 2 and 4, your final compensation period is your highest consecutive 78 biweekly or 36 monthly pay periods. And the biweekly or monthly depends on how you're paid. Most people are paid biweekly. So essentially, for tiers 1 and 3, your highest year of pay, highest consecutive year of pay, is your final compensation period. For tiers 2 and 4, your highest 3 years of pay is your final compensation period. In order to do the calculation that we need to do to find an average monthly salary, we simply need to take your total pay over that highest year or 3 years and divide it by the number of months in that period. So we'll divide it by 12 months or 36 months. That gives us an average of what you were making during that entire 1 year or 3 year period. And that is your highest average monthly salary. And that is the number that we put in the formula for you, multiply it by the other two numbers. And that tells us how much to pay you every month for the rest of your life through your pension benefit payment. Now, what types of pay are going to be included in this highest average salary calculation? Well, first of all, let me take a step back and say that all of these types of pay are gross pay. That means that we're looking at your paycheck before any deductions have been taken out, including taxes or anything else. Okay. So the types of pay that are included in the calculation are, of course, your base pay is going to be included. And then some of you may have other pay codes. Sometimes these are known as footnotes. And these are often other pay codes based on skills and education. I can't tell you whether one of your pay codes will be in or out of this equation because there's like 1,000 of them, and I don't know them all off the top of my head. But you can go to our website, go to acera.org/paycodes, and there will be a list of the pay codes for your employer. And you open the list, and it will say yes or no, whether your pay code is in or out. You find your pay code, and it'll say yes or no. If you need more help, you can ask your payroll manager to help you find your pay code on the list. And the one pay code that I know that never counts is overtime. Now, if you were in tiers 1 and 2, there are 2 more types of money that can be included as salary for the purposes of calculating your retirement. If you sell vacation back to your employer while you're still employed, that's called vacation sale. And some of that could be included. Some of that compensation could boost your salary. Or if you have vacation left over on the books when you stop working, they'll cash you out for it at that time, and some of that could be included. Now, I don't take a deep dive into this topic in this presentation because it takes like 20 to 30 minutes to go through all the different details of this. I do talk about that in the pre-retirement webinar. So if you are curious about that topic, what I recommend is after this presentation, go out to our website, go to acera.org/seminars, scroll down to see one of our previous pre-retirement webinars, fast forward the YouTube video till you see this slide, and then I will launch into a discussion of how vacation pay can increase your average salary by a little bit and thereby increase your retirement allowance. But that's just tier 1 and tier 2 people, not tier 3 or tier 4. Okay, so this goes to answer a question that was early on the Q&A board. Are there limits? Is there a cap on highest salary Acera considers in the equation? For tiers 1, 2, and 3, there is no cap on salary that we consider for the equation. For tier 4, there is, and that's just because that's the way the state wrote the law that created tier 4 back in 2012. So we don't have any control over this. That's just the way it is. That's just the way it was written. So the way this works is that we cannot include, when we go to calculate your retirement, we cannot include any more annual dollars for calculating your salary than whatever the cap is for that year when we're doing the calculation. Or actually what it is for the years when you earned the money that is in your final compensation period. So your final compensation period is going to be over 3 years, so there will be 3 different caps each one of those years. And when I say that, what I mean is the caps go up every year. So these numbers every year about this time, they increase, and we know what they are. We post them out on our website. So they go up and up and up. It's based on the Social Security wage index limit. And so we do have to cap the dollars that we include for calculating your retirement at these dollars. Okay, so that's the bad news. The good news is that if you do have a salary that's higher than the cap, whenever you have earned this amount of money up to the cap during the year, like maybe that happens in October, November, for the rest of the year, we will not take retirement contributions out of your check. And that gives you more money in your check to perhaps put into your 457B account to save more money toward retirement. So that would be my suggestion. If you want to know more about this topic, you can visit acera.org/limits, and they talk about that. And then looks like I answered your question already. Yeah, the cap goes up every year whenever the Social Security wage index numbers go up. What you're seeing here is the whole thing put together, the whole formula put together, just to give you an example of how it works. So this Tier 4 member, they retire at age 65 after earning 25 years of service credit. Because they're in Tier 4 and they're retiring at age 65, when we look at the chart, we see that their age factor percentage is 2.30%. They will get 2.30% of their highest salary for each one of these 25 years. So again, if you take the 2.30%, add them all together, add 25 of them together, that tells us that they are achieving 57.5% salary replacement. But rather than do addition, just multiply them together, 57.5%. And then that gets multiplied by the salary. So $3,450 is 57.5% of their highest average monthly salary, $6,000. If you achieve almost 60%, this is 57% salary replacement from the Acera pension alone, you're doing really good. Okay, so next topic. Let me show you, rather than talking in general terms about what your future pension might be, let me show you how to get a custom estimate and paint your own picture of what you are going to receive from Acera based on the pension that you earned during your career. I'm going to show you 2 ways. The first way is by getting a very ballpark number. And really what it is getting a sense of what percentage salary replacement you're going to achieve based on your retirement scenario. And then you can kind of take that salary replacement percentage and think about your salary, and that would give you a dollar amount. Okay. So let me address this question real fast. Is retirement income taxed similarly to income from employment? It's taxed exactly like income from employment. There's no special category of retirement income for the IRS. So whatever your income is when you retire, you're going to have to pay taxes on your retirement income from Acera because you contributed to the system on a tax deferred basis, which means that your income is your tax liability is being lowered currently. So you didn't pay taxes on the money going in, so you're going to have to pay taxes on the money going out is basically the bottom line. But theoretically, your income will be a little bit lower then, so you will have to pay a little bit less total tax dollars. Okay, and let me address that last question when I get to retirement eligibility. Okay, first of all, the first way to get a retirement benefit estimate, to get an idea, a picture of what your future retirement pension payment is going to be, is by looking at one of these salary replacement charts. And rather than look at the screenshot, I'll just go out and show you where to get this. So here's our homepage. You go under members, the first category, and you can get to this from any page. It's just, I usually start from the homepage to orient you. Okay, so you go under the third category, planning your future retirement income. Open that up. And what you're seeing here is a step-by-step process of what I'm going to talk about toward the end of the presentation, which is getting a full picture of your future retirement income. Now, step one is getting an ACERA estimate. It gives you 4 options. I'm going to open option number 1, and there's buttons here. The buttons open up the PDF for your tier. I'm going to press General Tier 4. So you just open up the PDF for your tier. And what you're seeing here is an income replacement chart. So these are all of the percentages in all the different scenarios of how much income replacement you will be achieving from your ACERA pension. Across the top, the x-axis is age at retirement. So you can see the different retirement ages that you might retire. Across the y-axis, down the column, is years of service credit. So you simply think of a plausible retirement scenario, and you find where that scenario intersects. So for example, let's say I was 30 years old and I'm thinking about retiring at age 60. That means that I will be retiring at age 60, and between 30 and 60, if I work full time, I will have earned 30 years of service credit. So I will just find where those two intersect. And if I worked for 30 years and retired at age 60, I will achieve 54% income replacement. Now, one of the features of this chart is that it shows you the effect of working more, working another year less. All you do is proceed diagonally to see working another year less. You're a year younger when you retire and you've worked 1 year less. So you would achieve 49.3% salary replacement, or another year younger, working 28 years at retiring at age 58, 44.8% salary replacement, or working a year more, 31 years, you achieve 58.9% salary replacement. So that's how these charts work, and that gives you kind of a ballpark idea of where you are regarding getting pointed in a trajectory of being able to maintain your standard of living. Now, if you wanted to, you could do an extra calculation, take your current monthly salary, multiply it by the percentage, and that would tell you an estimated number of dollars that you would receive every month in retirement. It's a very ballpark because likely when you retire 10, 15, 20 years from now, your salary is going to be higher through cost of living increases and raises. Okay, so that's way number 1. Most people might just skip that and go right to how to get a precision estimate, which is way number 2, which is to use our online benefit estimate tool. All you do is you go to acera.org, acera.org. You press the login button. You will get into your account, which we call Web Member Services, and you will see an account summary screen. Now, every time you go in here, it's good to check your information to see if it makes sense. Does my service credit number make sense? Is my date of birth correct? And, the first time you get in here, you can check the dates. The dates aren't really going to change. Is my tier correct? So on and so forth. Okay, then what you're going to do is click the Estimate a Benefit button. This brings you to our benefit estimator. You think of your plausible retirement scenario. You put in dates that match that scenario. You hit, and I'll just zoom in here so you can see it better. You hit Calculate. It will give you a projected amount of service credit and a projected highest average monthly salary, also known as final average salary, that we are using to calculate this estimate. You can put in beneficiary info here. I recommend leaving the overrides blank. Do not put anything in the hours of cash vacation compensation, and then click Get Estimate. And this is what you end up with, a PDF estimate that you can save You could print this out if you wanted, if you like to keep your records in paper. And the middle box is your estimated monthly retirement benefit. So I'll zoom in on that. What you want to look at is this number right here for right now. Because you're a new employee or you're in the middle of your career, I would just go by this number. You do have numbers for the other retirement options, but really you don't really need to think about or learn about different retirement options, because you can see there's 5 of them, until you get closer toward retirement. And then you assess your situation at that time and you decide if you want to take one of the other options. The vast majority of people will choose the unmodified option because it pays the highest retirement allowance of any of the options. And so you can just kind of go by this for now. And this is an estimated dollar amount that you would get paid every month for the rest of your life. There's a question, do I need any sort of code to create an online account? You don't. You just need to know there's some personal information that it asks you, and you just need to be able to answer those personal security questions, and then you can create a username and password. Question, how long after the start date will new employees have access to the Acera account? I think it takes about maybe 3 months. You are going to get a welcome letter in the mail from Acera after you are uploaded into our system. And then once you get that welcome letter, then it's likely that you could create an account because your information is in the system. Okay, this is a short topic, and then we can take a break. Understanding retirement eligibility. When can you actually retire? Because of course you probably know that you can't do it immediately upon working, like after a year, but there is some period of time very soon where you could actually retire if you wanted to. We're talking about this day on the pension milestone chart. This is the first day that you could retire if you want to. You could apply to retire on this day, or you could not, and you could keep working and earning more credit toward retirement. So I'll show you the options for tiers 1, 2, and 3, and then the next slide is tier 4. So if you're in tiers 1, 2, and 3, you have 3 different combinations that get you to retirement eligibility. So options 1, 2, and 3. Option number 1 is that you are at least 50 years of age, you have at least 5 years of service credit that you have earned, and you have at least 10 years of membership with Acera. Now, all of these tiers closed more than 10 years ago. So everyone in these 3 tiers should have more than 10 years of membership. So you don't really have to think about that. You just have to have at least 5 years of service credit and be over age 50, and you can retire. So you don't actually need that much service credit to retire. Now, if you do retire with only 5 years of service credit, your retirement allowance will be rather modest, but that's okay. It will still be, fairly significant, and it'll probably pay for a bunch of your bills in retirement. Okay, now option 2 is that as a general member, you can have 30 years of service credit, or as a safety member, you could have 20 years of service credit, and you can retire at any age, even if it's younger than age 50. Option number 3 is that you could be 70 or more years old, and you could retire with any amount of service credit, even if it's less than the 5 years that you would need under option 1. So those are the 3 combinations that get you to retirement eligibility. For tier 4, there are 2 combinations. Option number 1 is that as a general member, you're at least age 52. As a safety member, you're at least age 50. And you just need 5 years of service credit, and you can retire from Acera. And like I said, if you only have 5 years of service credit, your retirement will be rather modest, but it's still a lifetime payment that's going to pay for some stuff that you're going to get in retirement. And I'm getting a question to repeat something. Go ahead and tell me what you want me to repeat, and I'm happy to do that. There is a question up on the board from earlier. So for general tier 4, the age factor percentage doesn't even start until age 52 at 1%. Does that mean I have to work until age 52? So yes, the minimum age that you can retire as a tier 4 member is age 52 for general members. So if you're not planning on working till age 52, you could just stop working earlier than that. It's just that you got to wait until age 52 while you can retire. So let's say that you work between ages 40 and 50 and earn 10 years of service credit, and you're done. You're like, I can't do this anymore. I'm out of here. I'm going to go try something else. Okay, so you can become what we call a deferred member. You stop working, you defer your retirement to a later date. So you wait 2 years, and then you can start drawing that ACERA pension check at age 52. So that is one option that you would have. Okay, so then there's a question at 10 years, it would be more. So under the tier 4 general example. So if you mean that if you earn 10 years of service credit, your retirement will be higher, absolutely. Because remember the equation that I showed you earlier, age factor percentage times years of service credit times highest average monthly salary. It's a multiplication, and it determines your retirement allowance. So if the service credit number is 10 years versus 5 years, that means that the retirement allowance is going to be double it would have been had you only had 5 years of service credit. So yes, the more service credit you have, the higher your retirement allowance is going to be. Oh yeah, you're welcome. Absolutely. Oh, you're welcome. Okay, I will save that question for later because we will definitely talk about that. You wanted me to repeat about the previous slide regarding eligibility for the regular retirement. So this one, so these are your 3 options if you're in tiers 1, 2, and 3, the 3 combinations that get you to retirement eligibility. You have to be at least age 50 and have at least 10 years of membership with ACERA, which you already do because you entered ACERA more than 10 years ago if you're in one of these tiers. And you have to have at least 10 years or 5 years of service credit. And that will allow you to retire. Sorry about that. Option number 2 is that you can have 30 years of service credit as a general member, 20 years as a safety member, and you can retire younger than age 50. Or you can retire at age 70 with any amount of service credit, even if it's less than 5 years. So I hope that answers your question. Oh, absolutely. You're welcome. Okay, and there's a question about reciprocity popping up. I will definitely talk about that shortly. Okay, so on to the next topic. Let me help you understand our additional benefits. We offer, in addition to the retirement allowance that you are earning and will collect, we offer an additional set of benefits, including medical, dental, and vision benefits. And you see that these say non-guaranteed. These are not guaranteed benefits like your retirement allowances. These are extra benefits that we offer. We also offer the possibility of applying for disability retirement. And that is if you ever become permanently disabled and you can no longer perform your job duties, you can apply for disability retirement. And if you're awarded a disability retirement, then there's a different process for retiring. And that is something, if you're curious about, I don't really do a deep dive into that here, but go out to our website and go to acera.org/disability, or actually, I'll just show you where that is. Under members, there's disability retirement, and we have a whole section on that, if you're curious about that. And then additionally, we offer death benefits. Okay, so let me tell you a few more details about the medical, dental, vision, and the death benefits. What you're seeing here is a chart of all of the extra benefits, the non-guaranteed benefits that ACERA currently offers. The reason that these are not guaranteed is because these are, like I said, these are extra. Back in the 80s, the county decided that their retirees needed this extra set of benefits to help pay for their lives in retirement. And so they started a reserve fund with ACERA called the Supplemental Retiree Benefits Reserve. And ACERA's Board of Retirement administers this fund, this reserve fund. They determine what the benefits are, and what their job is to ensure the sustainability of the fund. So they set the benefit levels and what the benefits are in order to maintain that sustainability so that there's money there to offer these kind of benefits for everyone in the future going forward. So they monitor this every year. Now you can see that there are 5 benefits here. There's a medical subsidy, which we call our monthly medical allowance, or MMA. There's 3 levels of that you could get to. There's also a dental subsidy and vision subsidy that pays 100% of the monthly cost of being enrolled in those plans. There's a Medicare subsidy that helps you pay for what Medicare charges you for being enrolled in Medicare when you turn 65. And then there is a supplemental COLA, supplemental cost of living adjustment, that maintains your buying power in retirement. The reason I'm showing this to you, and because you might be wondering, I'm new, I really need to know all this? This is all benefits after retirement. Well, the reason I'm showing it to you is because it can help with career planning, because the board has these rules about who qualifies for these benefits, and it's based on years of ACERA service credit. And reciprocal service credit does not count toward this, only ACERA service credit. So you can see the supplemental cost of living adjustment that maintains your buying power is the only one where you don't need any years of service credit to qualify. Everyone has access to that once they lose a certain amount of buying power. For all of the other ones, it starts at 10 years of ACERA service credit. And then for the medical subsidy, you could get to 2 more levels at 15 or 20 years. So the reason I'm telling this to you is this can help with your career planning, because let's say that you've already been here for 9.5 years and you're wondering if you should change jobs, you're wondering if you should go work somewhere else, you may want to consider hanging around for another 6 months and getting over that 10 years of service credit mark, because that could represent a lot of additional money in retirement. This is paid on top of your retirement allowance. Between the medical subsidy, dental, vision, and Medicare, that could represent a lot of additional money in retirement. So that's why I like to come to the pension milestone chart and actually add a milestone to it, which is the healthcare subsidies number of 10 years. So once you achieve 10 years of ACERA service credit, this is a milestone that you may want to consider in your retirement planning. Okay, so let's see here. And then there's a question, the other benefits is for everyone. For example, people who have only 5 years. Well, if you have only 5 years, on this one, you would only be able to access the supplemental COLA. Death benefits is just something that everyone has access to. Death, stability, retirement, everyone who becomes permanently disabled has access to that. And then let me talk more about the death benefits, and that will help answer your question. Okay, there's a question on your pay stub in the before tax deductions column. You see nothing that says 457B or deferred compensation. You only see retirement tier 4. Can you still join the 457B plan? Absolutely. You can join the 457B plan any day of the week. All you need to do is fill out the application. And when Gene Hilliard comes on at 11:15, he's going to show you how exactly to sign up for the 457B plan, and you could do it today. So it's never too late to sign up for the 457B plan to save additional money. MMA stands for monthly medical allowance. That's the name of our medical subsidy. The question is, do you have to enroll in these? When it comes time and you want healthcare through ACERA, you would have to enroll in those, but we walk you through all that. And all the details of this, you don't really need to. I mean, the plans, they change from year to year. So you don't really need to sweat the details about this. That's why I just show you this years of ACERA service credit to qualify at this point, because that's really what you want to know in the middle of your career, or if you're a new employee, just that these exist and how you can access them. And would these benefits only apply to the employee, or is the spouse considered? These subsidies are only for the employee, but you can enroll the spouse in your plans. And then there's a question, what's added to Medicare when getting the monthly medical allowance? Well, when far in the future, when you become Medicare eligible at age 65, you can choose a medical plan through us that works with Medicare, where Medicare pays most of the costs. And then you can use the monthly medical allowance to subsidize the cost of being enrolled in that plan through us. And then the question is monthly medical allowance after 20 years of service, full or just a percentage of the medical? It's just a percentage of the medical, because this is a dollar amount that the board sets every year, and it doesn't pay the full cost of the premium. So you have to pay the difference, but it makes it way cheaper. It pays most of the cost. Okay, so I'm going to move on. If you want more information about the medical benefits, what I recommend doing is going to our website and going into the retirees section, and there's a whole section on healthcare, and you can read our enrollment guide as well and see what the current retirees are, what their plan options are. Okay, let me talk about death benefits and designating your beneficiary or beneficiaries for them and keeping them current. So I like to define this word because I didn't used to know what it meant. I did not used to know what it meant. Beneficiary is someone who gets benefits. Your ACERA beneficiary is somebody who you designate to get your ACERA death benefits for when you pass away. Now, this discussion that we're going to be talking about is all of the death benefits that your beneficiaries would have access to that are payable to your beneficiaries should you die before retirement. If you want to know about the death benefits that come with the 5 retirement options, I recommend going out to our website, going to acera.org/death. And that is the page that lists out all of the death benefits before retirement and after retirement. We're just talking about death benefits should you die before retirement. Okay, so, and this will go to answer one of the questions up on the board about the 5 years of vesting and the benefits. Okay, so if you're not yet vested in ACERA, meaning you do not have 5 years of service credit yet, if you die before you retire, while you are still employed, I don't mean you're dying at work. You just currently have a job with one of our 6 participating employers, so you're an active ACERA member, which is what active member means. What your beneficiaries would get is a return of the balance of your contribution account. So all the employee contributions you paid into ACERA, plus all the interest that we've paid on top of it. We would give them all that money back. Plus, they would get 1 month of your salary, your current salary, for each year of service that you've already done, up to 6 months worth of salary. So for example, if you've worked here for 3 years so far, we would return the balance of your contribution account and then give them 3 months worth of your salary. Okay, so then if you are vested, you have at least 5 years of service credit, your beneficiaries get an expanded set of options. Option number 1 is the same as the non-vested. It's the exact same, so they can take that option. Option number 2 is to a qualified beneficiary only, and it is a monthly survivor's allowance. So instead of this lump sum payment that they would get a survivor's allowance every month for the rest of their life. Qualified beneficiary is spouse, state registered domestic partner, or minor children. And you can read more about that on the death benefits page at acera.org/death. For the spouse or state registered domestic partner, it would be a lifetime monthly survivor's allowance. And what they would do basically is they would calculate your retirement allowance that you would have got as if you retired on your date of death, and then your survivor would get 60% of that every month for the rest of their life. And that's if it's a spouse or state registered domestic partner. If it's a minor child, then it has a cutoff at age 18. But it can continue until age 22 if they're enrolled in college. Option number 3, but there's more about that on the death benefits page. Option number 3 is a hybrid of options 1 and 2. They have a lump sum payment, the 1 month of salary for each year of service, up to 6 months worth of salary. And then there's a smaller monthly survivor's allowance that they would get. They pick the option. You don't pre-choose this for them. All you do is designate your beneficiary ahead of time, and I'll tell you about that in just a minute. Before I do that, I want to tell you what would happen if you stop working here and you don't retire yet. You become a deferred member. So you have deferred your retirement to a later date. You're still an ACERA member. What happens if you die in deferred status? Well, we would return the balance of your contribution account to your beneficiary or beneficiaries, because that always needs to go back to them. Okay, now, like I said, there's more info at acera.org/death, and you will want to keep your beneficiary designations current. Okay, you can change your beneficiary designation at any time. Active or deferred members can change their beneficiary designation at any time. That means that you can update your beneficiaries at any time using our beneficiary designation form out at acera.org/forms. You should, as a general practice, periodically check your beneficiaries, especially after you have major life changes. So you log into your account on our website, you click the nominated beneficiary menu item, and you see who your beneficiaries currently are. You have probably designated them when you entered Acera on our member enrollment questionnaire, or at some point you designated them on our beneficiary designation form. If you go here and you see that your beneficiaries are outdated, like maybe your spouse from 3 spouses ago is still your designated beneficiary, you're going to want to go ahead and redesignate your beneficiary unless that's the person you want us to pay your death benefits should you pass away before you retire. There's even a link right up there that will take you straight to the form. So you can just check your beneficiaries and then it'll take you straight to the form. And as soon as you send us that beneficiary designation form, we will log that into our system and your beneficiary is redesignated. Your beneficiary can be your sister. So if your beneficiary was your sister, though, they would only be able to choose option number 1, which is a return of contributions and interest and the 1 month of salary for each year of service. Because options 2 and 3 are only for spouse, state registered domestic partner. No, it's also Alameda County domestic partner. So if you have a domestic partner that you've registered with Alameda County, they could also qualify, even if you haven't registered them with the state. That's a new thing that we just our attorneys reinterpreted that and expanded it for those people. Okay, so career planning options. So we have kind of 2 sections left. Career planning options, and then making a retirement planning picture. So when I say career planning options, what I mean is you're going to stop working here one day. Like you cannot work here until the sun burns out millions of years from now. You have to stop working here one day. And what are your options in regards to your Acera account when you stop working here? Well, option number 1, and I'm going to show you 2 options. Option number 1 is you work straight into retirement, which means that you are working here, you're earning retirement, you make your retirement plan, and then when it's time to stop working, you stop working and retire from Acera immediately. If you do that, you're going to earn service credit right up till retirement, and we will convert your sick leave to service credit on a 2-to-1 basis. So any sick leave you have on the books up to a cap, but the cap is pretty high. I talk about that in the pre-retirement webinar. We will convert it to service credit. So you'll get half of your sick leave as service credit up to the cap. You could even go work somewhere else if you want. Like, let's say you retire from Acera at age 52 and you feel like you have a lot of energy, you want to go work somewhere else. We don't care. If you retire at 52, you're an Acera retiree. We pay you every month for the rest of your life and you can go do whatever you want. And you get your Acera retirement at the same time. Okay, so that's option number 1. Option number 2 is that you do not retire straight after active work. You do not go straight from active work into retirement. You do something else. You stop working and you don't retire from Acera yet. Okay, now I'm going to show you 3 sub options in this category. So I called the other ones 1 and 2. These are going to be A, B, and C. Your A, B, and C options should you terminate before you retire and not retire immediately. Okay, so I'm also going to add, or I'm going to move this milestone on the milestone chart. So there's a gap here because many of you who don't retire immediately are going to become deferred members and retire later. And so you would be stopping work at some point well before you retire, and then sometime later you're actually going to retire. Okay, so here's options A, B, and C. Option A. Option A is that when you stop working here, you can become a deferred member. You can leave your contributions on deposit with the SARA. And that's pretty much the only thing that you need to do to become a deferred member is you stop working here and you don't take a refund of your contributions, which is going to be option C. That's coming up in a minute. So you just leave your contributions on deposit. You're automatically a deferred member. You're still a member of a SARA. The word member is in there. You're just kind of on hold. Okay. So you're still an SARA member. And this answers a question from earlier. Interest is going to continue to accumulate on your contribution account. And in fact, there's no negative interest. And people ask me what I mean by that. What I mean is that the balance of your account never declines. It only stays the same or goes up. So if a SARA's fund has some adverse investment experience in the short term, like let's say the balance of a SARA's fund drops in the short term, your balance of your account does not drop, which is in stark contrast to what happens to your 457B or 401k or IRA when the market goes down. Your SARA account does not drop, okay? And interest continues to accumulate. And if you go back to that page that I showed you, asara.org/contributions, and see the kind of interest that we earn typically, if you go back and look at the average, it's over 7% a year. 7% a year risk-free. I can't think of another place where you can park your money risk-free like that. Okay. Now, you can retire later out of deferred status, and many people do this. So you stop working, then you're in deferred status, and you retire at some point in the future. You submit your retirement application and retire and start drawing your pension that you earned. Or alternatively, you could come back to work and earn more. Maybe that was your plan. You wanted to go try something else. If that didn't work out, you can come back and earn more credit toward retirement if you haven't retired yet. Or alternatively, you could take option C and be refunded at any time. For more information on this, I would recommend going to asara.org/defer. There's a list of reasons that you might want to defer and a list of reasons that you probably don't want to defer your retirement. Okay, so that's option A. Option B, when you stop working here, is you can establish reciprocity with the different retirement system. And you would do this by getting a job for another California public agency that SARA has reciprocity with. Okay, so somebody was asking what reciprocity means. This is what it means, is that the retirement systems get linked together and it synergizes them. You get some benefits from linking them together. We can link the other pension systems in California that some cities have. They have their own pension system. The other counties in California that have their own pension system, like Alameda County does, the state pension system, which is known as CalPERS, or any agency that uses CalPERS to provide a pension to their employees. The full list is at asara.org/reciprocity, along with all the other info about reciprocity. And so the reason that you might want to do that is because maybe you want to try something else in a different location in California, but you don't want to start over earning your pension from scratch. You can link them together. And the benefits of reciprocity is that the first one is that the service credit that you earn under all the systems combined get you over the vesting and retirement eligibility requirements. So let's say that you are tier 4. You work over in Contra Costa County for 2 years. You stop working over there and you immediately get a job working for one of Asara's employers, and you earn 3 years here. Well, that's 5 total years. If you have 5 years and you've linked those two systems together, 5 total years, 2 in the first, 3 in the second, you're vested. You're considered vested in both systems. And if you're over age 52, you're eligible to retire. So that in tier 4. So that is the synergy that I'm talking about for the service credit. Now, the synergy for the highest average salary is that all of the systems that you have linked together will use your highest salary earned under any system when they go to calculate your retirement. So For example, you work in Contra Costa County for 10 years, earning $20 an hour. You come over to one of Acera's employers, you're earning $30 an hour, and you work for 5 years. Then you go to retire. You submit a retirement application to both systems to retire on the same day, and we will each do our own calculation. Contra Costa County is going to do theirs, and we're going to do ours. We're going to use your 5 years here. We're going to use your salary here because it's the highest of any system, and your age factor percentage here. That's going to spit out a dollar amount. That is your Acera pension. We'll send you a check every month for the rest of your life. Over at Contra Costa County, they're going to do a similar calculation. They're going to use your age factor percentage over there. They're going to use your 10 years of service credit over there. And then they are going to see in their database that you have reciprocity with Acera. They're going to call us up and they're going to say, what is the salary that they are earning? And they're going to find that the salary that you are earning here is higher. So they're going to use that number over for their calculation, which means you're going to get a lot more dollars for the work that you did over there, even though you weren't earning as much over there. Finally, if you're in tiers 1, 2, or 3, establishing reciprocity could put you in an earlier tier, and that could make your contribution rate lower. It's possible. You can, in some cases, it could be higher, but you could talk to one of our staff about that. And some people ask, do we do retirement counseling before you're ready to retire? And the answer is kind of. What we do is instantaneous retirement instantaneous retirement counseling and career planning, because you can call us at any time. We have a call center with 3 people standing by, and they're just there to answer your questions. And that's what they do all day. They're experts. And you can just call us. If you go to acera.org/contact, you can find our contact info, and you can email us through there too. Okay, so the question is, can reciprocity be established without being vested? Yes. All you need to do to establish reciprocity is do these 4 simple things. 1, you become a deferred member with every system you're linking together. You don't take a refund when you leave one system. You just leave your contributions on deposit over there. You become a deferred member. Number 2, you have to establish the new job within 6 months. You can have no more than a 6-month gap. So if you leave Contra Costa County, for example, sticking with that example, 3 months passes, you start your new job with an Acera employer, you can establish reciprocity. Number 3, you want to have no more than 12 weeks overlapping service. This is very easy to achieve. Overlapping service is where you're on vacation leave for the first job and you immediately start the second job, so you're on 2 payrolls at once. Just avoid that, because stop the first job, start the second job, don't overlap them. They're going to cash you out for your vacation anyway. Number 4, you have to retire from all systems on the same day. So to answer your question, you could work for 6 months over at one place and get a new job at another place. Maybe you work for 6 months at Contra Costa County. You work here, you get your job here, and then you find, I want to try something new. Maybe I'll go work in Marin County. I'll move over there and work, see what happens. Maybe you go work there for a few years. Then you decide, not that happy here. Maybe I'll go work down in San Francisco County. So you go do that. You could link them all together as long as there's no more than a 6-month gap in between them. Okay, that's option B. Option C is, if you're not taking option 1, you're retiring immediately, and then you're not taking option A, which is deferring your retirement, or option B, which is establishing reciprocity with another retirement system in California. You're wanting to take option C, which is taking a refund of your contribution account. Now you can do that. And what we will do is, if you fill out the form, request a refund, we'll give you back all the money that you paid in and all the interest that you've earned on that. Now, there's some things to think about if you're going to do this. One is that if you're just looking for cash and you're not trying to roll over the money into another pre-tax retirement account, you're going to lose 1/3 of your money immediately. To income taxes, which you're going to owe immediately that year, and perhaps penalties if you're doing this under age 59. And there's state and local taxes, state and local penalties, and that equals about 1/3 of your money. To avoid losing a third of your money, you roll that money over into a pre-tax retirement account, and we will walk you through that. Refunds take time. They can take more than 60 days. So it's not an instantaneous thing. And you have to have, completely quit your job to be able to take a refund and access that money. And what you're telling us is you want to cancel your SARA membership. You want to waive your right to all the SARA benefits. You're saying, I don't want to retire from a SARA. I don't want a lifetime pension. I don't want access to the healthcare benefits. I just want to take the money and go figure out what to do with it. So you can do that. And that is your right, that it's your money to do with what you want. But remember something I told you at the beginning of the presentation. If you actually retire from a SARA, if you earn enough, like you earn more than 5 years of service credit and you earn enough to retire at some point from a SARA, we are going to give you all that money back anyway within your first 3 to 5 years of retirement payments. It's all going to go back to you. And then you will receive a lifetime's worth of extra retirement payments on top of that. So if you live, an average lifespan, I don't think it's going to be a good deal for you if you can retire from a SARA and draw the lifetime pension. I don't think a refund is ever a good deal, because I don't think that there's a lot of places that you can take your money and get kind of like lifetime returns on your money that a SARA offers through the pension payments. One more thing on that is you don't have to decide immediately either. You could, when you stop working here, take option A and just become a deferred member. If you don't know what to do yet, you can just take option A. Later, you can take the refund. Or you could come back to work and earn more, get over the 5-year mark and retire. Or you could wait till age 70. If you only have 3 years in, you could wait till age 70 and draw a pension payment. Okay, so those are your career planning options. Last topic. We're going to make a retirement planning picture. So you are seeing this slide again. Like I said earlier in the presentation, financial planners will tell you that in order to maintain your standard of living in retirement, you're going to need 80% of the salary that you were making while you were working in retirement. And you do that through these 3 categories: your SARA monthly pension, Social Security, and savings and investments. And these should all add up to 80% of your working salary. And so you might be asking, well, how do I know? How do I know if I'm pointed in the right direction? Well, it's actually fairly simple, and you can use technology. You can use the SARA pension estimator, Social Security estimator, and then there are tools to find out additionally how much you can save, and I'll show you how to do that. Step 1, get your SARA pension estimate, and you can get out some scratch paper whenever you sit down to do this, because you're going to want to keep track of these numbers so you can plug them into the calculator I'm going to show you later. So you get your SARA pension estimate, and you're going to get a Social Security estimate, and you can kind of keep track of this stuff on your scratch paper. So the SARA estimate, you go out to our website, log in, use the benefit estimator, get the estimate. Look at the unmodified option. Take note of which age and what you're doing here is a plausible retirement scenario. The example I'm giving you is age 62. So this person is age 62. They got back their SARA estimate from the calculator, and it's about $2,200. Okay, you go out to Social Security's website. They have a very similar estimator. You log into your personal account on the Social Security estimate. They give you a custom estimate based on the data that they have for you, and it will look something like this. They'll give you 3 different ages when you can start taking Social Security. The youngest is usually age 62. And they'll give you a dollar amount. This is how much, in this example, Social Security is going to pay this person every month for the rest of their life after age 62. Okay, so you can kind of keep track of that on your scratch paper. Now, I'm going to stick with this age 62 example just to make it simple. So imagine that I'm doing my scenario at age 62. I'm getting about $2,200 from a SARA and $1,700 from Social Security. Okay, step 2 is to go out and use a retirement calculator. And in fact, I recommend trying a bunch of them. I have 5 listed here out on our retirement planning page. We have links to all of these. The top 2 I would recommend are the Vanguard calculator and the Empower retirement calculator. Empower is the company that runs the 457B plan now. They bought it from Prudential. And Gene Hilliard, the 457B representative, is going to talk all about that and tell you how to use the Empower calculator. Because he's going to do that, I'll show you how to use the Vanguard calculator and get pointed in the trajectory of 80% retirement salary replacement, 80% salary replacement. So what I'm going to do is I'm going to come out to our website, and instead of showing you this stale screenshot, I'm just going to do it live. Like, what was that guy's name? Bill O'Reilly, do it live. If you've never seen that YouTube video, I highly recommend it. It's quite amusing. Okay, so you come down to planning your future retirement income. It's under members. It's the third one down. This is the step-by-step process that you can use. I'm just kind of taking you through the 10-minute version, but you can sit down and, it could take 5 minutes to an hour that you could do. It actually doesn't take that much time to get the SARA estimate, get the Social Security estimate, which is step 3. We have links out to everything. And then what you're doing is you're taking that equation that needs to equal 80% at least, and you're figuring out if there's a gap. And if there is a gap after you look at the SARA pension and the Social Security, how much additional might you need to save to achieve 80% income replacement? So I'm going to click on the Vanguard calculator here. There is a link to the Empower retirement calculator and the other examples that I gave you. And I'm going to plug in some numbers. And this is what you're going to do. You take your situation, you plug it in. So I'm going to take a hypothetical person who's 30 years old and is retiring at age 62. Let's say they make $70,000 a year. Okay, now in this field, they're asking what your annual savings are toward retirement. If you currently save additional money for retirement, you could plug that in here. Let's just leave it at 0 for now. Let's say you don't save anything. It's totally fine. If you haven't saved anything yet, you don't save anything yet, totally fine, because we'll figure it out right now. This is where you could put in if you've already saved something. So maybe you have $1,000 put away, or maybe you have 0. Let's keep it at 0, see what happens. Okay, this is where you are setting your goal for your salary replacement percentage. So let's just do 80%. This is the general recommendation from financial planners. But Gene Hilliard actually is going to tell you how he's going to try to get you pointed at 100% in just a few minutes. Okay, so this number right here, you can close that out. This number right here is the annual return that you can expect from your retirement savings. And what that means is that this is assuming that you're going to take your extra savings and you are going to put it somewhere where you can earn interest on that money, annual interest, compound interest every year. And this number should be somewhere between 2% and 7%, I think. Okay, but it's up to you. The higher the percentage, the higher the potential return. What they say is the higher the risk. But when they say that, what they are really talking about is short-term risk. What we're doing here is making a long-term retirement planning picture, and this is 32 years long. So if you look at the history of markets, while they go up and down in the short term, they tend to go up over long periods of time. And so for example, if you look at a SARA's historical annual return over the last 30 years, it's over 7%. I'm just going to put in 6% to be a little conservative. And so what I'm doing here is saying that any additional money that I'm going to save, I'm going to park it in a diverse array of investments like the 457B plan, for example, that is going to give me a diverse portfolio where I'm investing in like hundreds or thousands of different stocks and bonds and different diverse things. And so it's likely that I'm going to achieve an average of 6% per year over this 32-year span. 2% is on the safe side, 7% is on the more aggressive side. But if you are doing it over 32 years, it's probably a good idea to be more toward the 7% and be a little more aggressive. In the Social Security field, I'm going to put in the Social Security estimate I got, and I'm going to put in the SARA estimate I got, and I'm going to hit calculate. Okay, what it's showing me here in the right column the gray box, is what it's estimating based on all the numbers I put in, how much income I'm going to need in retirement, dollar-wise. Okay. Over here, it's showing me how much income based on the numbers I put in that I'm actually going to have based on my Acera pension in the light green and Social Security in the dark green. Now you can see that there's a gap here. I'm not quite achieving on this trajectory how much I will need to pay for my life in retirement to achieve that 80% income replacement. So I may need to save additional money. If there's a gap, I probably will need to save additional money. So let's go put in some more numbers. Let's say that I save $400 a year, which represents 0.6% of my $70,000 annual income. Hit recalculate. Okay, it only went up a tiny bit. I'm going to need to do more than that. What happens if I save $6,000 per year, which represents over 8%, 8.5% of my annual income? Okay, well, that's actually more than I need. So if I can't save that much now, I could go lower. So let's say 4,000, which represents 5.5% of my annual income. Recalculate. Not quite. There's a little bit of a gap. This one's 4610. This one's 4667. Let's try 4,400. Recalculate. Okay, so now they're about even. This one's a little more, and you can get granular, but it actually doesn't make that sense to get totally granular at this point because your retirement is a ways away. And all I'm telling you, all I'm suggesting is to get you on a trajectory. So what this is saying is that I will be in the trajectory of achieving 80% income replacement in this scenario if I save an additional $4,400 per year. And that may sound like a lot, but let's say that I break that up over 26 pay periods. Well, that's $169 per pay period. So maybe you can find some room in your paycheck to save that additional amount. And if you do it in the 457B plan, you save $170 per month or per pay period. You're not going to see a $170 impact because it's on a pre-tax basis. So it'll be some fraction of that. Gene Hilliard will tell you all about that in just a few minutes. So if I get on this trajectory of saving 6% of my salary with every paycheck into something like the 457B plan or some other estimate, I will have achieved 80% income replacement by the time I go to retire. So that's how you make a picture right now. You can do that today. You do it this week. Retirement is a ways off, so don't get stressed out by this. If you can't quite do the amount that it's telling you, just start something. Just start somewhere. Get pointed in the direction. And then come back 6 months later or a year later, and maybe you can do a little bit better. So redo the calculations, and it will tell you probably a little bit different amount. And so then you readjust. You can readjust your withholdings to the 457B plan or whatever, wherever you're saving your additional money. And over time, if you do this readjustment about every year or every 6 months, you will find that by the time you get to retirement, you will have achieved 80% income replacement between your Acera pension, Social Security, and your additional savings. So that's how you do that. So it's not actually that complicated. The calculators do all of it for you. The Acera calculator, the Social Security calculator, and then the retirement calculators. You can Google retirement calculators to find more of them to see, what different numbers that you get. But I do recommend trying out the ones that we linked on our website, including the Empower one, if you sign up for the 457B plan. I have a little more information here. I don't want to take too much more time because I want to turn it over to actually the real financial planner, Gene Hilliard. I'll just mention a few things really quickly. And all of this stuff, all of these last few slides are discussed in detail on that retirement planning page. So if you want to revisit these topics, you can find them on our retirement planning page. It's good to save your money somewhere where you can earn interest because it helps you beat inflation and it helps you earn more money over long periods of time through the power of compound interest. And compound interest is where you put some money, you invest some money, you earn a little bit of interest on top of what you invested. Okay. Then the next time you earn interest, you're earning interest on that larger amount. Then the next time you earn interest, you're earning interest on that larger amount. So there's an acceleration. You're earning interest on the interest on the interest that you've already earned. And that's why you can earn larger and larger amounts over long periods of time. Of course, be cautious with where you put your money. Put it in like normal stuff, like the 457B plan, where they basically help you invest in, large swaths of the market, so that like if one individual stock tanks, it's not going to affect your entire diverse portfolio. And when I say normal stuff, what I mean is like the 457B plan, or like if you have an IRA and they give you different options in there, or there's some low risk options that we have listed out on that retirement planning page that you could read through. We also have some moderate risk options in there. What I mean by non-normal stuff is like Bernie Madoff type stuff. If you watch that documentary on Netflix, he seemed to be this guru, and he took your money, and he said he was investing it somewhere, and he was earning these huge amounts of interest that nobody else could earn. But really, it was a Ponzi scheme, and he wasn't investing it anywhere, and he went to prison. So if you like your cousin's roommate has some, financial guru that he's saying that, you should invest all your money with, be super skeptical about that. That is, when I say normal places to park your money, that is not a normal place. Okay. So there's more on that at acera.org/planning. That's that retirement planning page that we have for you. And you can just take your time, do it step by step. It has links out to all the calculators. Okay, so I am going at this point to move on to the last subtopic of this retirement planning picture topic, which is starting a 457B account. And I'm going to bring in the expert to tell you all about that, because I am not the expert on this. So let me promote you to panelist. Okay. All right, Gene, are you there?
I am here, Mike. How's it going?
Going really well. Thanks for
Good,
coming.
good. Let me share.
Okay, let me stop my share.
Oops. All right, here we go.
Now, Gene is the representative from the county's deferred compensation plan. If you're not a county employee, all of this information is still going to apply to you. So Gene is the expert here. So I will let you take it away, Gene.
All right, perfect. Thank you very much. Well, good morning, everyone. My name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. We help our clients with financial planning. We do taxes for folks, and we also do accounting for small businesses. My firm was hired, and I was hired roughly 14 years ago. And we were hired by Prudential Retirement at the time, which is now Empower, because Prudential sold their business to Empower. But so now I'm a subcontractor of Empower. And I was hired for the most part to assist Alameda County employees with retirement investment advice, guidance, if you needed some navigation on retirement planning, and also to provide education, doing seminars, just giving you the tools necessary to be successful in life and to build wealth for you and your family. A little bit about my background. I've been a licensed independent advisor slash stockbroker for roughly 20 years, helping my clients create wealth, maintain that wealth throughout their lifetime of their children, lifetime of their grandchildren, if that's something they're looking to make happen. And I'm also a retirement counselor. And my goal as a retirement counselor is to help each and every one of you maintain your current lifestyle in retirement. right? What do I mean by that? Well, I want you to, as Mike had mentioned earlier, I want you to the exact same paycheck you're getting today, give or take a few pennies, assuming your raises over the years. I want you to get that exact same paycheck in the future in retirement. So that's where the 100% comes in. Okay. Um, and one of the best ways to make that happen is through deferred comp. I mean, the good news is you guys work for a great organization, Alameda County, one of the last of the Mohicans in terms of having a pension. So if you spend a significant amount of time with the county, 20 plus years, 30 years, you're looking at least getting 50% of your salary. Now, don't quote me on that. That's probably more of a Mike question, or you can just go on the Acera website to figure out how much you're going to get, but you're looking at roughly half your salary. So you're halfway there, right? You got 50% covered plus Social Security. Now we need to make up that difference with deferred comp. And I'm going to talk a little bit about deferred comp for roughly the next 30, 45 minutes. And these are the topics I'm planning on discussing. You know, bridging the gap from Acera pension and Social Security. The fact that you can money comes out of your paycheck. I'm going to talk about tax deferred savings and deferred comp. I'm going to talk a little bit about the investments, moving money from your previous employer to Alameda County. I'm going to talk a little bit about your withdrawal options at the time of retirement, catch up options in terms of being able to put even more in deferred comp. And I'll talk about loans as well. Okay. Now, most financial planners will tell you that you really only need 70 to 90% of your income in retirement. Actually, it's closer to 80, right? You need roughly 80%. Why not 100? Well, think about it. There are a lot of costs that go away in retirement. So just think about what you're paying now that you don't have to pay in the future. For example, do you have to pay into Acera when you retire? The answer is no. You do not have to pay into Acera. So if you look at your paycheck and it says tier 4 or tier 2 retirement, and it's going to show you how much is taken from your paycheck, you'll see that goes away, right? If you're contributing to deferred comp, and by the way, there's a question from question about this presentation. Yeah, we're going to post this presentation on the Acera website sometime today, but talk to Mike after the presentation. He'll give you some more details.
Yeah, I
But
think I think we need to update the one that's currently out there. So if you could email it to me afterward, I can update it on our site, and it will be
okay,
posted at acera.org/seminars.
perfect. Thanks, Mike.
Sure.
So you don't have to pay into deferred comp. You don't have to pay into Acera. Guess what? You don't have to pay Social Security taxes. That goes away. So there's a lot of costs that go away in retirement. So most people don't need 100%, right? But you know, the way I see it, hey, let's shoot for 100, and if we need to settle for 80, so be it. But I will tell you this: in many cases, when financial planners talk about this 80% or 70%, they're basically talking about your needs. And remember, there's needs and there's wants that I'm sure you're dealing with now, and there's needs and wants that are going to be in retirement. Okay. So you got 70%, 80% covered for your needs. Now let's talk about the wants. Do you have enough money set aside to deal with or pay for your wants? People tell me all the time, Gene, I want to travel. I want to travel the world, you know, or I want to travel to the various states in the union. That's not cheap, right? It's going to cost you. Where are you going to go? Right? How much are the airline flights or gas, etc.? You want to spend time with family. A lot of folks want to do that in retirement, given the fact that we've spent a lot of time apart during COVID, and we're probably still doing it because we're still in the middle of this pandemic, so to speak. So you want to spend some time with family. Where does your family live? In New York, down south, right? Up north, where does your family live? Do you anticipate when you do travel to see your family, are you staying with them? Most people will say, you know what, I'll stay with my sister when I travel to go see her in retirement, right? And I'll save money in terms of hotel costs. But I will tell you this, I was thinking about it. A lot of my family, they live in Georgia, in the Atlanta area. And I would spend a lot of my time going over staying with my own sister. But every time I decide, because I have other family members, I have other friends that live in Georgia, and every time I wanted to leave to go visit another family member or to go visit a friend that lives in the area, my sister is looking at me cross-eyed. Like, what is this? What's going on here? Are you just staying here like I'm a hotel? So I've decided, all right, I am gonna stay in a hotel so I can have the ability to go see who I want when I want without my sister's feelings getting hurt. So I just figured I'd throw that out. But hey, if you got good relationship with family members, stay with them. That'll save you some money. Um, Folks spend some time between two separate homes, right? That's not cheap either. If you don't have that second home, then you need to start saving right now toward in retirement or start saving to get that second home, right? So there's a lot of costs that go into retirement, especially when you're dealing with your wants. And I encourage folks, save some money for your wants. You've worked extremely hard your entire career up to this point. You've scrimped, you've saved, and when you're retired, you should have an opportunity to do what you want. Because tomorrow, what COVID has also taught us is that tomorrow is not promised. So enjoy the time that you have when you're in retirement doing some of the things that you enjoy. Okay. So let's talk again, take a step back and talk about deferred comp a little bit more. It's easy. If you've ever had a 401k, if you ever had a 403b, you know that it's pretty easy. Money comes directly out of your paycheck. Every paycheck, just like a SARA, just like taxes, it comes out of your paycheck. So when you don't see it, you don't miss it, you don't spend it. People ask me all the time, all right, how much should I put away towards retirement? So that's a moving target. It all depends on what your goals are in retirement. But if you're 20, 30 years away from retirement, who knows? But I typically tell people, shoot for at least 10%, 5 to 10% of your salary, and that's per year. So just take 10% of your annual gross salary, divide that by 26 pay periods, and that's roughly how much you should take out. Is that too much? If it's too much, then that's fine, right? Cut it in half, but start somewhere and then continue to build on that as you move through your career. As you get raises, bump it up a percent or two, right? And I encourage, get promoted, take these tests, make more money so that you can put away, which will potentially give you an opportunity to retire sooner than you think. Now, there are two tax advantaged ways of investing in deferred comp. And deferred comp, by the way, it's a 457B plan. So make sure you guys write this down. It's a 457B. It's not a 401k. It's not a 403B. It's a 457B. But here with the county, we call it deferred comp. But there are couple of ways that you can invest in deferred comp. You can invest pre-tax or after-tax Roth. Let's talk about the pre-tax. Money is put into an account before taxes, right? And it continues to grow and grow over time, and you pay taxes in the end when you retire. The pre-tax version of deferred comp or any pre-tax investment works best if you believe you're going to be in a lower tax bracket when you retire. Pre-tax, you think you're going to be in a lower tax bracket when you retire. Makes sense. All right, I'm investing money now. I'm deferring taxes because I'm working. I'm in a 28% tax bracket. Now, fast forward the clock 30 years, I anticipate my income's probably going to drop slightly. And it's safe to assume because my income drops, my tax bracket is going to drop as well. So instead of paying 28% now, I'd rather pay 20, 15% in the future. You never get around taxes. It's just a matter of when you pay them. So that's the pre-tax version. Now, there are some folks that believe that regardless of how much I'm making in retirement, I think taxes are going to go up. We're running up debt as far as the eye can see as a country. And I believe, taxes are going to go up. And I'd rather pay the taxes today. Makes sense. So you go with the Roth version of deferred comp, right? You're putting money into the account, you're paying the taxes. So my earlier example, hey, I'm in a 28% tax bracket now. I want to get that out of the way. Fast forward the clock 30 years. I believe I'm going to be in a 35% tax bracket. I avoid having to pay that because I've already paid the taxes. So any money that you pull from the Roth, the growth of that money is not taxable. Pretty good deal. It's not taxable provided that you're at least 59 and a half and the account's been open for at least 5 years. Okay. By the way, you can contribute to both the Roth version of deferred comp and the pre-tax version of deferred comp. Not a problem. You can do both. Many people do both. Why? Because I have no idea what the tax code is going to be in retirement. I have no clue. No one knows for sure, right? Congress could change the tax law at any point in the future. So that could happen. So if you do both, then hey, you're going to win. But if over your career you've been doing the pre-tax version of deferred comp and you decide you want to switch to the Roth, you have to remember your taxes are going to go up. So don't panic or freak out if you switch and all of a sudden you end up owing when you file your tax return. It's because of the fact that you decided to go away from the pre-tax version and do more Roth. So just kind of keep that in mind. Make sure you get ahead of that and at least be prepared for it. Okay. Compounding. Mike talked a little bit about compounding. Investing in some sort of tax deferred vehicle allows your money to work harder for you, right? This particular slide is a slide that it's basically talks about the rule of 72. And I don't know if you guys have heard of the rule of 72, but any two numbers multiplied together that equal 72 or close to 72 kind of gives you an idea of what rate of return and how many years it would take for your money to double, right? For example, say I have money in an account and I'd like for my money to double in 7 years, right? So if you get a rate of return of 10% in 7 years, your money will double. The 10 times 7 doesn't equal 72, but it's close enough. And you can do the math any which way you want. Every two numbers multiplied together that gets close to 70 gives you an idea of when your money will double. And you can flip that. If I want my money to double in 10 years, how much risk will I need to take on? Well, you need to get a rate of return of 7%. Or if I have a rate of return of 8%, it's going to take me 8 years for my money to double. See, the 9 times 8 is 72. So that's the rule of 72. And that just gives you an idea of when your money is going to double for you. Okay. How much can I contribute to deferred comp? Well, I mean, we're almost at the end of 2023, but 2023, the max for someone who is under 50 is 22,500. Now, some people may be thinking, well, Gene, is there a way I can get that 22.5 in here this year? Well, unfortunately, you're not going to be able to do that because money comes out of your paycheck. It's got to be payroll. The best that you can do in terms of saving for 2023 is to set up the account and then ask the county to put in 60% of your income into deferred comp. That's the max in terms of a percent. So that's the most that you can get in there. 60%, and then you can get that in and you do the best you can. I mean, we probably have maybe 4 more pay periods, 5 for the year. Okay, that's the only way you can get the max in here as much as you can. So if you're under 50, 22,500 for 2023. If you're 50 and over, the IRS will allow you to put away an additional 7,500, bringing your total to 30. Now, I'm sure you're thinking, well, all right, what's the max for 2024? Well, it just recently came out. It went up $500. So if you're under 50, you can put away $23,000 a year. And if you're 50 and over, the IRS will allow you to put away 30,500 max for 2024. Now, there are some folks who would really like to put even more into deferred comp, and that's where you can take advantage of what is called the 3-year catch up. What is that? Well, if you're 3 years away from normal county retirement age, which if you're a regular county employee, I believe that's 54 and a half. If you're safety, it's 47. So that's as soon as you can participate, and you can put away uh, twice the under 50 amount per year. So uh, for 2024, if you wanted to take advantage of the 3-year catch up, you can put away $46,000 a year. That is the max, but you have to qualify. In order to qualify, the way it works is you'll contact Darnell Williams, say, hey, I spoke with Gene. He talked about the 3-year catch up. I want to see if I qualify. And then what he will do is he will pull your records, your income records throughout your years with the county, and see if there were years that you weren't a max contributor, that you could have put money in. Right. So I'm sure many of you, when you first started with the county, you didn't contribute to deferred comp or even the first 2 years. Well, there are some years that you could have put money in. So he'll run the numbers. He will tell you specifically if you can take advantage of the 3-year catch up. And this is only if you want to put more than next year's maximum, if you're 50 and over, is 30,500. So if you're interested in doing more than 30,500, then you want to take advantage of the 3-year catch up. If you have no interest in doing more than that, then don't ask about it. It won't apply. It's all about people who want to do more than the 50 and over catch up. Okay. I'm going to check here, see if there's any
Yeah, I was just about to
questions.
ask. I was
Yep,
typing a
go for it.
response to somebody else, and I don't know
Okay.
if you went through any of these questions yet.
Okay, let's see. Some of these questions I've gone through, at least the one about splitting your money between pre-tax and Roth.
Okay.
The how does the 80% consider inflation? When we talk about 80%, it does consider inflation, right? Because we're looking at the 80% is going to be the 80% of your annual salary when you're close to retirement. So we probably need the person who asked that question probably would you might be better for you to schedule an appointment with me, and I can talk to you a little bit more detail about that. And let's see, can you repeat, Vanessa? Let's see, can you repeat about 457 again?
Catch up.
450. Oh, the catch up. I
Yeah.
think I covered that. Did I cover that okay? If you're 50 and over, you can put away for next year is 46,000. If you're under 50, you can put away $23,000 a year. And then the 3-year catch up that's the one where you can put $46,000 a year. And I don't think I mentioned you can do that for 3 years prior to retirement. You don't have to retire after the 3 years, but you don't want to retire in year 3 of when you're about to retire. Okay, so
Okay.
3 years. So at 54 and a half, you can participate and put away 46,000 year 1, 2, 3. And then year 4, you can retire. Or if you want to continue to work, you can. No harm there.
Okay. And
Okay,
if you
go
leave the
ahead.
county, can you collect but not collect the pension? Can you continue contributing to the 457B?
That's a good question. This is deferred comp is an employee benefit. So once you leave the county, you are no longer allowed to contribute. And by the way, you can't even roll over money into deferred comp after you retire if you had money elsewhere. And I want to talk a little bit about that in a moment.
So at that point, you would want to probably, if you want to save extra money in a retirement account, you'd probably look at an IRA.
Yep. You want to look at an IRA, assuming you have earned income, right? You cannot use, some people ask me this all the time. I'm getting money from my Acera, which is a pension. Can I put a portion of my Acera into an IRA? And the answer is no. And the pension is not really considered earned income from working. Now, if you come back as a retired annuitant or you go do a part-time job somewhere and you have earned income, then you can contribute to an IRA. Okay.
Okay.
All right, so let's talk a little bit about a hypothetical example of a person who wants to save towards retirement at various ages and they want to retire at 65. How much can they anticipate having in their deferred comp account? So here's an example of a person who's 25 years old. I met with them, we ran the numbers, we talked a little bit about retirement, and I encouraged them to put away $300 per month. 150 a paycheck. So for 40 years, they're age 65, they're looking at having a balance of $575,089. Now, this is assuming a 6% rate of return, which is not unreasonable. That's entirely possible to, on average, to get a 6% rate of return. But here's another hypothetical example of a person who is now 35. They heard my presentation 10 years ago, but they were hard-headed. They didn't listen, but they had their reasons. Gene, I'm just not making a whole lot of money with the county at the time. My first position, or I got student loans that were, offer deferment that I needed to start paying. So I just couldn't afford it. But now I got my raises. I took some tests. I got promoted. I'm making a little bit more money. Now I'm ready to put some money away towards retirement. But because they waited, you're looking at $500 a month as an example. I'm not saying this is for you. This is just a hypothetical example. This person is going to retire in 30 years. So they want to retire at 65. And they're looking at having a balance of roughly $490,000. Pretty significant amount of money, right? I'm confident that that amount of money is probably going to get that person closer and closer to that 100% salary that we talked about. But here's an example of a person who started a brand new career with the county at 45. That happens. They switched gears and they wanted to do something different. They're putting away $1,000 a month. That's what I'm encouraging. For 20 years, you're looking at $455,000. So the point of this slide is, yes, we want you to start ASAP in order to allow the power of compounding to run its course. So you can pretty much have a pretty significant balance. But all is not lost if you're waiting later in life in terms of saving. You can still create a pretty significant amount of money. And people ask me all the time, is it ever too late to invest in deferred comp? In my view, it's never too late. If you're 5 years away from retirement, 3 years away from retirement, 1 year, it doesn't matter. That's still money that you're saving in taxes, right? And it's still some money that you're going to have an account that could be used to pay a water bill or pay your PG&E. It's never ever too late to save towards retirement. So I encourage it regardless of your age. Okay.
There's
I'm
a
sure
there's a
there's a
comment.
question. Hmm.
There's a comment, not a question, but a comment. They say they started contributing to deferred comp since 1992 and started with $25 per pay period, increased it by 10 to 25 with each raise, and after 33 years, they've gotten up to contributing $500 per pay period.
Nice.
That seems like the way to do it.
That's the way to do it.
Yeah.
Whoever that was, thank you for your comment. You were listening, I'm sure. It's amazing to me. Most people, when they first start with deferred comp, they think they can't afford it. They really do. And then they start with the 25 and then you don't even miss it. It's like, am I still putting $25? And then you see the growth. So that gets you motivated to do more and more and more. So when it comes to deferred comp, I encourage you guys, go talk. If you're not in the plan, go talk to the smartest person in your department or the person that's been in your department the longest and ask them about deferred comp if it's a good idea. And I'm 99% sure that person is going to tell you, hey, deferred comp is the way to go. I wish I would have started sooner than I did. Okay. All right. So many of
There's a
you,
couple of related questions.
okay.
If I put in 40,000 of my actual money over time, will this increase over time based on interest, or will my money decrease based on how the stock market is going?
Okay, I'm going to get to that. The
Okay.
answer is depending on what you invest in. If you invest in the Alameda County Stable Value Fund, that's a guaranteed rate of return. It's just interest payments. It's like a money market. But if you
Okay.
invest in the stock market, it's going to move around. So it's going to be up and down from year to year. Short term, it could be up or down, but you want to look at the average of the rates of return over the 30-year period or 20-year period. And I'm going to
Okay.
talk a little bit about investments soon in this presentation.
Okay.
And
And
you
can you,
said there was another related question?
yeah, can you change the amount of your contribution at any time?
The answer is yes. You can change the amount at any point. There is no open enrollment to sign up or a certain period where you can change your contributions. You can do it anytime. But you don't want to be frivolous about it and change it every month. Stick with a number that you're comfortable with working through for an entire year. And then if you want to increase it down the line, you can.
And
But to answer your question, yes, you can change it at any time.
you do that on a form, or what do you do?
Okay, well, there's something that's called a payroll modification. You can use either a form that I can email to you, or it's on the Empower website, or you can do it online. So if you go log online, you click payroll modification, then you can go in and make a change. If you're unsure where to go, shoot me an email and I'll send you the link to make that change.
Okay. And then there's one question that they really want to know because they've asked it 3 times. So sorry we didn't get to it yet. How long after you open a 457B plan can you pull out a portion to invest in a home?
Um, Well, I mean, there isn't really a particular time frame to withdraw money or to borrow. I'm assuming this person is talking about borrowing, and I was going to get to that. Haven't got
Okay.
to it yet. But you can only borrow 50% or $50,000, whichever is less. So if you haven't had the money in deferred comp that long, you're not going to have a whole lot to borrow from
Right.
because the most you can take out is 50% of your
Because
account.
you're not borrowing someone else's money, you're borrowing your own money.
That is correct.
Yeah.
You're borrowing your money and you're paying yourself back with interest.
Yeah. Okay. And
Okay.
I'll let you move on and we'll get to the next 3 questions in a few minutes.
Okay, perfect, perfect. And I'll try to get through this. I'm sure you guys know about this presentation, you know about deferred comp. You just want to get those questions answered. I get it. So I'll try to go through this a little bit faster. All right. So just know also that if you have a deferred comp account, a 401k at a previous employer, that money can be rolled over in deferred comp without taxes. Contact me and I'll show you and tell you exactly how you can make that happen. Okay. Once you leave county service, you got $1 million in deferred comp, 500,000. You can pull money out monthly, you can pull money out quarterly, once a year, you can pull money out whenever you need it. It's ad hoc. 30 years ago, there was a process where you had to tell the county how much you wanted per month, and that never could change. So there's flexibility here. You can pull money out whenever you need it. Okay. But just recognize, at least at the moment, if you're 73 and no longer working for the county, you're required to take out a minimum required distribution, which is roughly 4 to 6% of your account. The other thing about deferred comp that I didn't mention is that there's never a penalty for withdrawals like a 401k or an IRA. So you can put money into deferred comp, you can leave the county for whatever reason, take a sabbatical. You want to stay at home with a baby that was just born. For the first 5 years, whatever it is, you can pull money, you can withdraw money from your deferred comp without a penalty. Now, you're still on the hook for taxes, but there's never a 10% penalty like withdrawals
So there's no
or
minimum
like
age.
401ks. Excuse me?
There's no minimum age that you need to be
That
to
is
start
correct.
withdrawing. You just need to quit working.
Yep. Soon
Yep.
as you leave county service, whether that's retire or you quit, it's your money. You can pull it out whenever you want to. You just need to be aware that you're on the hook for taxes. Now let's talk about loans. You can borrow against your deferred comp. I encourage people to use the loan feature responsibly, because this is your retirement, this is your future. Okay. Now, if you want to borrow the money to buy your primary resident or a new home, now that's good use of the money. All right. So you can borrow against your deferred comp. You pay yourself back with interest. If you're borrowing to purchase your first home, you have a maximum of 15 years to pay that money back. Right. The interest rate, at least at the moment, is in the 9% range. Now, I know that seems really high, but you're paying yourself back. It's not like that 9% is going to a bank, going to Empower. It's going back to you. You're borrowing and you're paying yourself back at 9%. The interest rate is tied to the prime rate plus 1%. And the prime rate, as I'm sure many of you are aware, interest rates are going up across the board because of inflation. So the prime rate is much higher. So you're looking, I think the prime rate is at 8. So that means you're going to be paying roughly 9%, at least right now. But you don't have to borrow the money for a house. If you want to borrow the money to pay down student loan debt, or you want to borrow the money to pay off a credit card, you can, but you only have a maximum of 5 years to pay it back. If you're interested in the loan feature, just log on the Empower website. There's a calculator there you can use. There's a couple of forms you'll need to sign, and you'll get your money in 3 to 5 business days. Okay, now let's talk about investments. There are two types of investors here. You have a do-it-myself investor, and you have a help-me-do-it investor. If you're a do-it-myself investor, I encourage you to do your homework. There's roughly 15 mutual funds. These are the funds. You have, person was talking about interest. The Alameda County Stable Value pays roughly 2% in interest. Okay, so if you want to invest in that, 2% guaranteed. If you're the type of person that prefers to invest in index funds, similar to, say, Vanguard, well, you have the Fidelity 500 Index Fund. Anything that says index fund, you know it's an index fund, and it's going to be inexpensive. Or if you're the type of person that prefers to invest in socially responsible investments, Impact Sustainable Allocation is a socially responsible mutual fund. Okay. But if you're the type of person that just wants to create a portfolio that consists of small companies, medium-sized companies, large companies, then there's investments in deferred comp for you. Okay. But I'm sure many of you are experts at what you do, and you need help. Well, Empower has a great tool called Goalmaker. It's an asset allocation program where you tell us what your investor profile is, whether you're conservative, moderate, aggressive. You tell us when you anticipate retiring, and then we'll do the rest. We'll pick the funds for you. And within that within Goalmaker, it has automatic rebalancing and it has age adjustment. Age adjustment, put it simply, is it as you get closer and closer to retirement, the account gets more and more conservative. Okay. Automatic rebalancing is a process where, hypothetically, say we tell you you should have 80% in stocks or stock funds and 20% in cash or bonds. So you're at 80-20. The market's moving around. Now your account, it consists of 90% stocks and 10% bonds because stocks have done so well. Rebalancing will get you back to the appropriate asset allocation or the appropriate amount of risk, the 80-20 that we just talked about. So they sell and buy the appropriate investments to get you back to 80-20. So that's the automatic rebalancing. Fees and expenses. There are a few different, there's a couple of types of ways in which fees are impacted. All right. About the expense ratio. Every mutual fund out there has an expense ratio. They're not doing it for free. And you want to try, in theory, to find the less expensive mutual fund that's going to give you the best rate of return. Right? So there's the expense ratio. Back probably about 3-4 years ago, there was a different way in which we handled fees, or the county handled fees. They were all tied to the mutual funds. So, for example, XYZ Mutual Fund had an expense ratio of 1%. hypothetically, you wanted to see what the rate of return was on that XYZ fund, and you found that it's 10%. But you wanted to confirm within your portfolio whether or not it was truly 10%. You wanted to make sure Gene was on the up and up. So you crunch the numbers and you realize that the rate of return on that mutual fund for you was 9%. You reach out to me and say, hey, Gene, what gives? You told me that the rate of return on this fund was 10. I only saw 9. Well, that 1% difference is the expense ratio. That's how fees are paid in many cases in plans like these or in any mutual fund. So the new county treasurer felt that that wasn't as transparent as it should be because people really don't see that fee because it comes from your rate of return. Whether you have a positive or a negative rate of return, it's still going to come out of there. So the county decided that they wanted to change the fee structure slightly. So they revamped all the mutual funds to make sure that they were inexpensive. Some hardly have any costs associated with it. The index funds, you're being charged 0.01% per year, right? Okay, so they changed it where now you're probably seeing, if you're in the county's plan, you're seeing money come out quarterly. And you're like, hey, I don't remember ever seeing fees. Well, it's because of the new fee structure. So the county is charging to be in the plan 0.20% per year. So that's what you're seeing coming out quarterly. Now, the expense ratios with the mutual fund, that doesn't change. They're lower than they have been in the past, but some of them still have an expense ratio. So for example, when you talk about passive investing, just remember that's synonymous with index funds. So with index funds, the expense ratio is going to be a lot lower. And as I mentioned, with the couple of index funds we have, it's 0.01%. But then you have active investing or active mutual funds. These are mutual funds where a manager is buying and selling stock on your behalf. And because they're providing their expertise, it's going to cost you more. So it's going to be 0.5% to 1% that you're going to be paying. But I strongly encourage folks, you don't want to just look at how much a mutual fund is charging you. And if it's too high, it's bad. No, I don't think you should look at it that way, right? It's all about the rate of return. If the rate of return on an active investor is giving me way, way more than what the index is offering, it might be worth it. So if I'm paying 1%, and let's say hypothetically the index is rate of return on the index is 10%, okay? But this manager who's charging me 1 is giving me 15% rate of return, then it may be worth it. You know, I'm getting 4% more in terms of rate of return, and I'm paying 1. It might be worth it. So take a look at both the rate of return on the mutual fund and the expense, and then make a decision based upon that. Okay. I know that was a lot. If anyone on this call wants this information in more detail, reach out to me. Let's have a conversation. All right, what's next? Let's get you signed up. If you're not in the plan, or if you want to increase your contributions, go to this website, AlamedaCountyDCP.com, right? Click on register, follow the prompts to sign up. When you log into deferred comp, look for payroll modification if you want to increase the amount of money that's going into deferred comp. But if you're not in the plan, I encourage you, start as soon as you can. You're not alone. We're here to help you. It doesn't cost you any more than what you're already paying through that 0.20% in expense ratios. You have access to licensed financial advisors that are at your beck and call. Right, so there's Mark Tomei on the left, you have Jason Brummett on the right, and you have myself in the middle. Hold on. To get a hold of us, call us at this 855 number, 855-969-4572, or you can log online to schedule an appointment, or you can send me an email. My email address is G_Hilliard, HILLIARD, at emergefinancial.com. So that's G_Hilliard at emergefinancial.com. So you can send me an email to schedule an appointment, or if you want to have a conversation, you can call my office directly if you want to just bypass this 855 number. Just call me at 510-562-55. So that's 510-562-6355. So with that, I'd love to entertain questions. What is on your mind?
Okay, great. Thanks so much, Gene. That was freaking awesome.
Thanks, Mike. I appreciate appreciate that.